their clients with particular securities like equities and bonds. Morgan Stanley have applied for a patent which would enable them to use AI to analyse communications from the Fed and try and get a sense of what interest rates are going to do next in the US. BNP Paribas, for example, are using it to detect fraud and money laundering.
Okay, that's all it sounds all very positive, but we can think back to the flash trading as banks embraced this kind of technology, at least built on their technology capabilities. So there's got to be risks. We know there are risks around AI. What are people saying about the concerns about how you fold artificial intelligence and large language models into the banking sector?
So Warren Buffett has flagged concerns on an earnings call recently about how once you've invented AI, you can't really take it back. That's like broadly the abstract concern. To be like more specific, one of the issues that people raise is you don't really know what goes into a large language model like ChatGPT at the beginning. All you see is the analysis that it puts out at the end. So there's very little accountability and transparency into like how it's coming to the conclusions that it is. It's having sometimes some of these models are having to hoover up low-grade data from all over the internet in order to train themselves to the level that they need, which means like sucking up analysis of Reddit and chat like formats like that on the internet, leading to like low. You know, we all know there's a lot of rubbish.
So, I mean, I guess it will change, right, as also the chip processors become more sophisticated. How will it change? Is it too soon to know how it changes the banking industry?
So, a month or two ago, analysts at Goldman Sachs put out a report warning that 300 million jobs ultimately could be exposed to automation in the future. They're not just talking about banking jobs, that's like across industries. Obviously, that's a very high number, and people will be worried about that. But there are these issues with accuracy around large language models that a lot of people say that will mean humans always have to have an oversight role here.
Thank you so much, Will Shaw. They're a finance reporter. One of the funniest memes is someone saying, like, AI, you know, if you're a graphic designer, relies on the human, giving you precise information on how you want the graphic, so there's no chance they ever got it.
Well, let's hope that. Some will be hoping that stays the case, won't they, in terms of preservation of jobs.
Now, the aftermath of UBS, Credit Suisse mega deal, is posing fresh challenges for the Swiss bank and its presumed chief executive officer in waiting. When Iqbal Khan joined UBS from its rival in 2019, the move sparked a tabloid scandal over a cloak and dagger surveillance operation on the star banker. But in this year's forced marriage of Switzerland's two biggest lenders, he's been conspicuously low-key. Let's bring in Bloomberg's Tom Metcalf. Tom, always great to speak to you because you always bring us like the juicy stories, and this is a pretty big, juicy story. So how would you describe Iqbal Khan's current position?
Yeah, it's interesting. He's kind of in a bank. He's been doing well there. As many insiders say, he's likely to be one of the sort of the heir apparents at UBS. But this acquisition of his old firm, of course, has actually kind of changed the stands a bit, right? So, as you'd expect, the bank around him's changed, and that's kind of made his position a little bit less sort of kind of clear-cut in terms of being this sole sort of front runner. And now that, you know, they've brought in obviously some Credit Suisse talent, and there's lots of other people within UBS who've been given pretty plum roles in terms of how to integrate Credit Suisse. So, you know, the big question is Khan, you know, as far ahead as other people, you know, are as far ahead as he was once?
I mean, we all remember the spying scandal, the surveillance scandal, of course, when he left Credit Suisse. How much goodwill does he have left, or does he have, with those current Credit Suisse employees?
Yeah, so look, we understand that, you know, there's definitely some tension, you know, with some people. So he's been flying out to various regions and, you know, looking to sort of, you know, pitch the UBS way and you know, try and smooth things over. I think, you know, within UBS, he's seen as doing a very good job. He's obviously running the whole wealth unit, which is an absolutely massive gig. And, you know, again, that seemed to be doing quite well. Some of the stuff he's imported from Credit Suisse has been bringing in extra revenue, etc.
Tom, what are you looking after, or what are you looking for actually in the next chapter of the UBS Credit Suisse deal?
Well, it's interesting. Yesterday was meant to be the day that the deal closed between UBS and Credit Suisse. You know, our understanding is that's been shunted back by a few weeks just to sort of dot the I's, cross the T's. So that's the next big thing in this whole saga, is that legal close. And then, of course, you know, into the summer, you have UBS's set of results, which will be absolutely fascinating. You know, how they present this, you know, what it starts to do to their results, or, you know, what they say it's going to start to do to their results.
Tom, as always, thanks so much. Tom Metcalf there, who oversees all of our coverage, of course, for finance here in London. Now, coming up, we'll have plenty more, of course, on the markets. We focus on Chinese data. we look ahead to some of the jobs reports we'll get, of course, and whether it's as relevant as it used to be because of what we heard from the Fed yesterday. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open, everyone. 50 minutes into the European trading day. For the moment, we're still seeing gains across the board. One of the biggest gainers is, of course, the DAX index, 0.9% higher. Look, there are concerns about AI and some of the AI stocks or technology stocks that filtering through to Europe. But overall, the focus is on better than expected economic data out of China, the fact that the House passed also the debt ceiling bill, and then a lot of focus, of course, on jobs and what that means for the Fed going forward. We're also getting some PMI out of Italy. I think, let me see if it's coming out, but we have to put this PMI in conjunction with what we're seeing, of course, on the CPI front. So we're also getting quite a lot of big news a little bit later on. So I'm not seeing that Italian PMI yet.
So the manufacturing data for Italy...
As soon as it's out. Is it out?
Yeah, for May, for the month of May, PMI falling to 45.9. So that's just slightly above the forecast, 45.9 versus the forecast of 45.8. But again, it's a reminder, it's in contractionary territory, of course. And when it comes to France, May manufacturing data coming in below the estimates, 45.7. So again, it just underscores that there is this divergence between manufacturing and the services part of the European economy. Let's get to an important interview that we set up yesterday. The incoming CEO of advisory firm Lazard says the US will eventually be hurt by its financial problems, and lifting the debt ceiling and the debt limit will not resolve underlying chronic issues. Peter Orszag told us more about where he sees the headwinds.
Normally, when M&A falls as much as it has over the past 2 years, you see a boom in restructuring. That hasn't yet happened. And the reason, I think, is twofold. One is we don't have a recession, which is what normally happens when M&A comes down this much. And secondly is the expansion of cov-lite lending over the past 5 or 6 years. More than 80% of the lending over the past 6 years has been Cov Light, which means you're not triggering the covenants as early in the process. Doesn't mean it won't happen, it just means that it's delayed. And then for Lazard, one of the things that's fantastic is we've historically been very focused on the debtor side. Our restructuring practice, which by the way is ranked #1 in the world right now, is expanding into the creditor side so that we can do both sides of the activity on both sides of that business.
Hey, Peter, it's Alex. It's so good to see you. Congratulations on the gig.
Thank you.
I hear you on, like, this is how we're setting up. There's going to be a downturn, but the Cov Light kind of pushes it out. Do you guys have an idea of when stuff will turn?
I don't think anyone has a great sense of that. What I'd say, if you're asking about the M&A market, is there are some key underlying drivers that are very positive for the market, and then there's some headwinds, one of which is being taken off the table as we speak. So the key underlying drivers are things like technology, the energy transition, the life sciences revolution, and so on. Those are all very positive for M&A activity. On the downside, or the headwinds, are market volatility and the interest rate trajectory, along with the debt limit, which maybe we'll turn to in a minute because it's being taken off the table, and then the regulatory environment. The good news is the underlying drivers are durable. Most of the headwinds are ephemeral. And so I think if you look out over the medium to long term, the prospects for a significant amount of ongoing M&A activity over the long term are very, very positive.
Peter, that's the long-term view. In terms of time frame, I just want to push you a little bit. Tom here in London, and thank you for joining us. In terms of by the end of this year, there's a debate, obviously, in terms of when the deal-making comes back, when that M&A comes back. Do you see that activity picking back up for you and the business by the end of this year?
Well, we'll have more to say about that when we report our second quarter earnings. So I'm going to just hold off on answering that question. What I would say is we are very well prepared and we are very well positioned for whatever market conditions come our way.
Speaking of market conditions, like you'd look at just the news yesterday, Goldman cutting a couple hundred more jobs. Morgan Stanley has been on its second round of job cuts, really. Lazard made a decisive decision here to cut 10% of its workforce. How does this affect jobs across the financial industry? And honestly, Peter, you were the banker, frankly, to First Republic as it was figuring out its fate. Is there more pain to be had across the financial industry as we look through the year?
Well, look, I think there's a lot of stress on the regional banking system in particular. And then also, as we've discussed before, M&A volumes are down 60% over the past 2 years, especially because many firms, including Lazard, did less headcount adjustments throughout COVID for understandable reasons. That's exactly what one would hope companies would do, which it would be a bit more protective in the middle of a pandemic. The combination of that and a substantial decline in M&A volume in the market as a whole is leading to the kinds of headlines that you were just referencing.
The incoming CEO of Lazard there, Peter Orszag, on the debt ceiling, on the overall debt load for the US, and of course on the prospects around a pickup in activity when it comes to M&A and that part of the business. In terms of the data coming through from Europe, we have some more lines crossing, this time from Germany. May manufacturing PMI coming in at 43.2, slightly above the estimates at 42.9, but again, firmly in contractionary territory. It's a bit of a mixed picture in terms of this manufacturing PMI across Germany and France, but what it does show is that manufacturing remains clearly under pressure. Across the European equity markets, as we look at the euro-dollar at 106, and it's a leg lower now, down 0.2% for the single currency. You're still seeing some optimism across these equity markets, gaining 0.7%.
That's it for the European Market Open. Surveillance Early Edition is up next, and this is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The U.S. debt limit bill heads to the Senate after winning passage in the House amid a looming default deadline. Fed officials say the FOMC may keep the policy rate steady this month, but more hikes could follow. U.S. equity futures are little changed, even as Europe opens higher. Plus, on the 25th anniversary of the ECB's founding, we get the Eurozone's latest CPI readings amid signs that inflation is actually cooling. Now, first thing is first, let's check on the markets. We also have a bit of PMI figures overall for the euro area. So we had the individual countries just 10 minutes ago. Euro area May manufacturing PMI coming in 44.8. Anything below 50, which this obviously is, means a contraction. It is a little bit better, really just a touch better than that preliminary figure of 44.6. Now, in the markets, let's check on euro dollar. I don't think it's having a huge amount of change, but 106.70 is what we're doing right now. The focus is on three things today, and actually they all seem to be pushing towards more positivity in the market. Again, it changes quite quickly. Every couple of days, the markets seem to be flip-flopping. They're all over the place. They're positive about China, then they worry about China. Today, we did have some manufacturing data out of China that was beating expectations, and so we have the China recovery play maybe back at the margins, the U.S. default now being taken off the table because we have a resolution, certainly with the passing of the House, and then, of course, the third encouraging news for the markets that the Fed could pause in June after we heard from two Fed governors. European stocks gaining 0.7%. You can see it's not having the same effect in futures. The focus is also on AI and the fact that after the huge rally that we saw on the back of NVIDIA, we're now seeing a little bit more pressure. The two-year yield at 4.45, and then crude oil 72.79. Now, I don't think there is much difference, but it's interesting to see there's not much difference in how some of these countries behave differently. But what was interesting is actually the DAX seems to be powering ahead, the biggest gain in terms of indices, 0.9% higher. So the debt limit deal has cleared the House, a major step towards avoiding a historic U.S. default. Lawmakers from both parties joined to approve the bill, sending it to the Senate for consideration, a win for President Biden and Speaker Kevin McCarthy.
Tonight, we all made history, because this is the biggest cut and savings this Congress has ever voted for.
Well, the president called the agreement good news for the American people and says it protects key priorities and accomplishments for the past 2 years. Now let's bring in Bloomberg's Ross Matheson with the very latest. So, Ross, what's the timeline for a vote in the Senate, and could there be any last-minute hang-ups at this point?
Well, the good news for President Joe Biden is that Senate approval is virtually a given, which means this deal does get through, and that takes the debt ceiling off the table through the US election cycle, and it only caps spending for 2 years. The main question is simply, when may a Senate vote happen? We have Republican leader in the Senate, Mitch McConnell, indicating that vote could come as soon as today. But beyond the passage, there are some other issues. Basically, some of the hard choices on spending have been left for after this deal gets through. And that means you're going to have some wrangling that goes on, particularly up until October, about some of the nuts and bolts about what gets cut and what doesn't. A lot to be ironed out. And of course, there are groups that are very unhappy with this deal. You've got progressive Democrats who say spending cuts are going to hurt a number of people in America, particularly the poor. You have ultra-conservative Republicans saying, hang on, spending's not going to be trimmed or cut enough or managed enough. So really, you've got quite fraught negotiations to come well after this deal gets through, possibly as soon as today. And that's really where we're going to see the fighting come out and the mess come out, which is exactly what gets trimmed and from where. And there's a lot still that's not clear on any of that.
So, Roz, how strong is Speaker McCarthy's position, given that he also needed considerable Democratic help to get this passed?
Well, his position has always been questioned, really, in some way. Of course, it took him, a dozen goes to become Speaker in the first place. And to do so, he had to make an agreement that a motion to vacate the chair, which is really an immediate vote to remove him, could come from one single person in the House bringing it. So that's put him in a delicate position from the outset in a House with only a narrow majority for the Republicans. And now you do have one representative, Dan Bishop, saying he will call for a vote to remove the Speaker. And as I was saying, like, ultra-conservatives say that McCarthy made a bad deal. It only got through Congress, really, with the support of the Democrats and less so the Republicans. And there is a precedence here, of course. His predecessor, John Boehner, he fell afoul of this in 2015 when Barack Obama was in power by doing deals then. But at the same time, McCarthy's been very visible through this process. He's not shied away from the media. He's remained front and center. And he may get some points just for doing that. And also for the Republicans, it could be self-inflicting damage to have a speaker fight at this point in time. It will create a mess for themselves they don't want. So perhaps that also might work in his favor.
Roz, thank you so much. Roz Matheson there with the very latest, of course, on this U.S. default. Now, we'll get Eurozone inflation data for May in the next hour. That's after some of Europe's major economies saw the pace of inflation cool for the month. The former ECB president, Jean-Claude Trichet, told us ECB policy is heading in the right direction.
I was impressed by the fact that this target, this definition of price stability, has been reaffirmed very, very strongly by Jay Powell and by Christine Lagarde, so that the goal is clear and there is a joint, I would say, definition of price stability.
Well, let's hear from our Europe correspondent, Maria Tadeo. Maria, run us through the data. So Euro area CPI in focus today.
Yes, Francine, very much in focus. We are waiting for that piece of data for May to hit in about an hour's time from that. We already had a number of national prints which would indicate a cool down for May. When you look at the details on the survey that we have on the Bloomberg, yes, another decline in headline inflation, a minor decline in core inflation expected, but not as fast. And that takes us to really what is the intellectual debate going on at the European Central Bank at this time. What is a persistent decline in inflation? When do you say, okay, the forces of monetary policy have really kicked in and inflation is on its way down sustainably? So you have to separate perhaps the energy to those forces that are more persistent in time. And Francine, just briefly, yesterday we spoke with the Vice President of the European Central Bank, Luis de Guindos. This morning he is on Spanish radio repeating this message that the ECB has probably entered the final stretch of the hiking cycle, and also says the 25 basis points, that is probably the new normal now. So that takes us to that decision in 2 weeks' time. Again, a clear indication it will be another hike, possibly around 25 basis points. The debate is now what happens next.
Maria, thank you so much, as ever, for that insight. Europe correspondent Maria Tadeo joining us this morning. Coming up, we speak to renowned economist and author Dambisa Moyo about the global economic outlook. That's next, and this is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but you know, we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, our next guest is a renowned economist and author. A Harvard and Oxford graduate, she sits on the boards of 3M and Chevron. She's penned 4 New York Times bestsellers on everything from why democracies fail to deliver growth to China's race for resources. Dambisa Moyo, frankly, just a very big brain. Welcome to Bloomberg. You're also Baroness and House of Lords, so you kind of really put everything together to look at the biggest challenges facing our economies. And I can't figure out quite yet if it's just inflation in the short term and then AI is the biggest unknown for the next decade.
Yeah, so glad to be here. I think the most important thing is growth. That is the question that everybody's asking about in public policy rooms. You know, if you think about the business sphere, everybody's talking about growth. And obviously anything that potentially could increase growth is something that is of great interest. And so AI obviously is a big piece of that discussion, notwithstanding enormous headwinds that could also come from that.
So how do you see it? Is it a transformational technology that will leave many companies behind if they embrace it, or is it a job destroyer?
Look, so I think just deferring to people who really are in the know, at the cold face of this. I mean, I was just in a room listening to some of the things that Sam Altman has said. I mean, obviously, the DeepMind people have talked about this. There clearly is going to be job diminution. And I think it's important for us from a business perspective as well as from public policy to accept that reality, meaning thinking about whether there's a new paradigm for what the role of government might be. You know, I'm not a big government person, but we have to think about the possibility of UBIs, or universal basic income, thinking about a welfare state, but also the transition from a business perspective. What kind of businesses can generate returns above the cost of capital in an environment where there might be less demand for labor?
So what do you think is some of the most interesting when you look at board levels? And I know you wrote beautiful books, you know, saying how boards work. Yes. Like, what are they asking themselves right now? Is it how they can support government the other way around, or do they feel like they just need to go at it alone?
Well, I think that there's no way we can survive. I mean, the reason companies exist is at the will of government, because of regulation, because of the tax environment. And so they're obviously, the more we can work together, the better. But at the same time, businesses have to really take a cold towel to their heads and think about business models. How do we think about capital allocation? How do we think about labor? But also, most importantly, productivity. Those 3 things are the key key engines for economic growth in a world where there might be less demand for capital because for one unit of capital you can generate more returns in terms of gains in productivity. In an AI world, we might need less capital, we might need less labor, and so how do we think about those trade-offs?
I mean, how do you see? I mean, I have to say, productivity has been you know, the big unknown, the big question mark for a lot of G7
big disappointment,
countries,
actually.
especially here in the UK.
Yeah.
Like, is there anything in the medium term that we can do to get this up would generate growth?
So I think that there's a lot of debate about whether or not we need to and how we should be bringing back labor into the markets, thinking about reskilling. I mean, all of these are ways that people are thinking about deploying talent. So it's the sort of, it's not man versus machine, it's man and machine kind of statements that you've heard before. I think that there's a bigger question to be asked about how do we think about business models in a world of AI. What I mean by that is that, you know, the traditional idea of one unit of capital, one unit of labor could generate with productivity huge gains might actually be facing a diminution. And I think that's the question that we're looking at right now.
And it's difficult because you keep on hearing it from really AI experts that it's the first time that we have such a big piece of technology that doesn't really put the human right at the center of it. It's actually really the technology that could change everything.
Exactly. This is the laborless growth point.
But so what does it mean for, you know, are we going to create quality jobs? And again, if you're on a board, if you're, you know, as an economist, like, how do you find out what needs to happen so that we still have a labor force, workforce participation?
Yeah, I think this is the big question. At a micro level, do we need more labor? But I think at a macro level, this could break up the whole idea of convergence that we've seen from emerging markets to developed economies. So if you think about the last 60 or 70 years, how did we get a lot of growth uptick? We brought women into the workforce in the 1950s. We had China sign up to the World Trade Organization in 2001. That brought more people into the workforce. But now we're talking about really a breakdown in that workforce and thinking about having fewer workers to generate more productivity. So I think this is a fundamental point. Keynes talked about this in the 1930s. He forecasted by 2030 we'd have a 15-hour work week. We've seen the arc of shifts in the economy from agriculture to manufacturing to services, you know, really break down. So as you know, 1900, we had about 60 to 70% of the workforce in agriculture. Now it's less than 2%. But in each of these changes, the workforce was absorbed into new skills, into new responsibilities. And now the question is, will that happen again? I'm not of the view that we'll have no new jobs, but I think the type of jobs that are going to be will survive, I think, are going to be highly technical, and this could be a problem for both emerging markets, but also for companies that don't catch up.
And I was going to say, actually, does it change the composition of, you know, continents? So how certain countries will do better than others, or really industries that will be completely disrupted, in certain cases, disrupted again?
So I'm going to be a good economist here and say on the one hand and on the other hand. On the one hand, I worry because I do think the precise skills that are necessary to succeed in an AI world are going to be skills that many emerging market countries just don't have. I mean, I'm talking about poorer emerging market countries. Obviously, China is a leading competitor in AI and quantum computing, etc. But on the other hand, there's a point that actually the world is becoming even more flat. And so productivity gains and things like open sourcing mean that anybody, anywhere can tap into those productivity gains. And therefore, there could be enhancements on a broad-based level. But I think these are questions that are still open out there. You and I haven't even talked about what are the risks and some of the headwinds that could come from AI that could undermine this whole productivity gain story. And also, maybe we don't see as rapid a diminution in jobs as sometimes we worry about.
I feel like today, this is a perfect, like, Baroness Moyo day, because we have quite a lot of China data that came in better than expected. 3 days ago, it was worse than expected. We have, you know, the US default that's kind of been parked for the moment, and then we have a lot of Fed talk and the fact that the Fed could pause in June. Are central banks overall doing a good job in managing this, you know, inflation, which is frankly all over the place?
Look, I'm much more sympathetic than I know the narrative's been quite critical. I actually was in Jackson Hole last August. I'm going again this year for the Fed meeting. I think it's a hard needle to thread. And, you know, we can sit here and speculate about whether they should have known and whether they should have acted more quickly. But given where we are today, I think that the story is still quite murky. I mean, you've seen the Spanish numbers. You know, we've got a relatively deflationary environment in China. And on the other hand, we still have, core inflation and actually inflation rising in many economies. And so I think, it would be very easy for me to be in the peanut gallery and throw stones. But I think on the whole, I think we're not in a bad place.
But there is a narrative that actually now we'll get away with not crushing the economy. Is it wishful thinking? I feel like there's...
Too early to tell. I mean, if I think about some of the data that I see in inventories, some of the slowdown I've seen in automotive sector, for example, I think there's reason to be worried. I think also there's a paper that came out of the BIS talking about how when you have these rapid rate hikes, the sort of accidents or challenges in the economy come later. So, I mean, I'm much more of that view. I think we've seen rate hikes. I think we could continue to see some challenges in the economy.
You sit in the House of Lords. What's the prescription for the UK to move forward right now in terms of growth?
So I've been very clear. I don't think a combination of high taxes and high regulation is a formula for success. I've been very clear in that. I was in my maiden speech around the spring budget in March of this year. I do think that, like most things, we're trying to solve today's problem today, but we should continue to think about the longer term prospects for growth, and really the numbers that the Chancellor forecasted through the March budget, I think are quite worrying. We're talking about 2%, 1%, 2%, not just in the UK, but in the developed economies in general. And I think those are things we should be worried about. And the OBR is also forecasted weak growth.
Dambisa, thank you so much. As always, I mean, we could talk for another hour, so you'll have to come back.
I will be back, Francine. Thank you.
Dambisa Moyo there, joining us on a wide range of topics. Now, coming up, the BRICS bloc of nations could be discussing plans for a future where global trade no longer depends on the dollar standard. They're meeting in Johannesburg today, so we'll have plenty more on that shortly. And this is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Shares in ADNOC Logistics and Services have soared on their debut in Abu Dhabi. The move follows a hugely oversubscribed IPO for the maritime logistics unit of Abu Dhabi's main energy company. The share price jump was the third biggest globally this year for a listing, raising more than $500 million. Now, U.S. job vacancies unexpectedly surged in April to the highest level in 3 months. Official data showed the number of available positions climbed to 10.1 million from an upward revise of 9.75 million in March. The reading exceeded all estimates in a Bloomberg survey of economists, giving the Fed more reason to consider hiking rates again. Nvidia's CEO said to be heading to China later this month to meet with tech executives in the world's biggest chip market. A source says companies on his itinerary include gaming leader Tencent and TikTok owner ByteDance. The CEO's first China trip in years will come as the US tries to curb Beijing's access to leading-edge chip technology. And that's your Bloomberg Business Flash. I'm Leanne Gerrans. Francine.
Leanne, thank you so much. Now, foreign ministers from the BRICS bloc of nations kick off 2 days of meetings today in South Africa. The group, which represents 40% of the world's population, is set to debate the possibility of a common currency. Now, member states are also expected to discuss the subject of new entrants. Now, for more, we're joined by Bloomberg's Sembile Tsele out of Cape Town. Sembile, what is expected to come out of this gathering, and could that actually include talk of a common currency?
Morning, Francine. Thank you so much for joining us. We are live in Cape Town, where the BRICS ministers, that is Brazil, Russia, India, China, and South Africa, of course, will be meeting ahead of the August summit that's set to take place a little bit later this year. Today, the 5 foreign ministers will be meeting to set an agenda, as it were, for that meeting when it does come. And of course, some of the big ticket issues that will be on the table is the expansion of BRICS, this country of clubs. They're looking to maintain more global influence in the world. And another point of discussion that has also come up is the idea of a common currency, of course, to try and reduce sort of the dominance of the dollar, as it were. And so what they'll be discussing today is the modalities around expansion. You have 5 countries in at the moment. There's a queue of others, the likes of Iran, Saudi Arabia, United Arab Emirates. They are amongst those that have asked to be considered to join what they, I assume, think there will be a formidable bloc in the coming years in terms of economic and military might as well. So those are some of the things that will be on the table over the next 2 days. Tomorrow, the Friends of BRICS will be joining them. Tomorrow, the Friends of BRICS will be joining them. And then, of course, in the background, struggling to hear you.
All right, Sembile, thank you so much. I think we're having a little bit of interruption on our Wi-Fi. Sembile Tsele out of Cape Town. We'll have plenty more. Up next, the UK show. This.
Do you think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New
Yeah,
York
the
City?
mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
DOJ or other authorities
Could face bigger challenges.
elections next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. Now, this morning, we're exploring the future of the UK auto industry under threat from trade rules, higher costs, and fierce international competition. As the sector switches to electric, Britain risks falling behind in the race to build EVs. Now, one of the big stumbling blocks is a requirement under the Brexit deal, which could add tariffs at 10% on cars traded between the UK and the EU. Now, the British government has until the end of the year to negotiate a way around a commitment requiring 45% of components in electric cars to be sourced in either the UK or the EU. That's for manufacturers to retain tariff-free access to the EU market. Now, car makers say the deal threatens the industry, with Stellantis warning that British car plants will close. This is what the Bentley chief executive told Bloomberg.
The good news is we got a free trade agreement with Europe post-Brexit, which involved the automotive industry. So we get mostly the same ability to trade with Europe as we did before, but it's way more complicated and it does cost us more money. Millions per year, not tens of millions per year. But there's always devil in the detail, and one of the details is that starting from next year, and even worse in 2027, there is a rules of origin clause which says a certain percentage of components going into the vehicle has to be sourced in Europe to avoid future tariffs. And at the moment, the amount of supply base in the UK, and particularly batteries, means it's unlikely to be able to hit that threshold. So volume cars going into Europe would have to pay the duty and the taxes, which makes them uncompetitive.
Well, the UK government has told Bloomberg it's working with the EU on car factory rules. Here's the Business and Trade Secretary speaking to us at the Qatar Economic Forum.
The EU, you're right, is our largest trading partner. We have a free trade agreement with them. But the terms in which we wrote rules of origin conditions don't work now with rising prices of components. This is not a UK problem. It is an EU-UK problem. It works both ways. So both sides are actually interested in looking at what we can do in order to resolve that. The trade and continuity agreement is up for review in 2025. We're looking to see what we can do in advance of that because, as you know, there are lots of global headwinds that are affecting the car industry.
So that was just over a week ago, but there have been no breakthroughs, and it's potentially a big problem for the UK. Some 780,000 people are employed in Britain's automotive industry. They produce almost 1 million vehicles a year, and 8 out of 10 cars are made here or then exported. Well, let's discuss all of this with Bloomberg's global car czar. He's Craig Trudell, as well as Michael Dean, a senior European automotive analyst at Bloomberg Intelligence. So thank you both for joining us. First, I mean, this seems like a little bit of a nightmare, right, to deal with and try and puzzle everything together. How serious, Craig, are these post-Brexit rules?
Yeah, I think this is a classic sort of tragic irony of this desire to get out of the EU led to some of the same complications and bureaucracy that was sort of what precipitated a desire to leave the EU, right? So this was a matter of leaving a customs union that made trade simpler and uncomplicated. As we heard from Adrian Hallmark, the CEO of Bentley, they became much more complicated, and it's going to be costly. And there is a sort of question of where do you want to direct your investment? A place that's low cost, less complicated, or higher cost and more complicated? It's a pretty simple question.
Yeah, so how can they change? I mean, I know that we can spend 2 hours saying why were they agreed in the first place, but if they were agreed, pre-Brexit, is there any wiggle room on how to change things?
I think certainly. You've also got to remember that although we export 50% of UK production to the EU, 65% of UK sales come from the EU. So it's an issue for both sides. So that means there should be a willingness for both sides to come to an agreement.
I mean, how much does this have to do with also costs coming up, that it's almost a perfect storm for everything?
Yeah, that's true. So 40% of a battery electric vehicle is the battery itself. Yeah. So given the increase in metal costs that go into a battery, this has become an issue, particularly as we transition to battery electric vehicles over the next few years.
And costs are not going to go up. Can I just spend a moment in saying the sartorial elegance of our car, experts is, it's a white shirt, it's a very classy white shirt with a very classy blazer for both of our experts. But when you go back to costs, I mean, these are not going to go down anytime soon.
Yeah, I think there's also a challenge of energy costs, right? It is a very energy-intensive business, making batteries, and so this is a case where where you're going to localize battery production is a big question, as Michael referred to. It's a huge part of the value of electric vehicles, and we have a lack of battery production in the UK. And not a whole lot of reason to invest in the UK when energy production is higher, when it's difficult to get to procure labor. There's a lot of complications here, and these are big, heavy components that are hard to transport from mainland Europe to the UK in a sort of cost-effective and easy manner.
But Craig, how much is this because of the automotive industry or batteries or some of the components, and how much of it is actually a struggle overall for any manufacturing in the UK?
Yeah, I think that's a big question. I do think that, in speaking with Adrian Hallmark at Bentley recently, he's talked about this issue of the challenges of immigration, and finding people to work in factories. So I do think that, the UK does have a lot going for it in that it has this long history of manufacturing a lot of cars. And it's a question of whether or not, the sort of retained expertise and experience is enough to make up for some of these other, aspects of the industry that have been the sort of reasons why so many manufacturers have been moving elsewhere.
So how do you revive this, right? I mean, and this is, I guess, what we're trying to figure out. And you write about this every day, as do you. When you look at the blueprint of how you fix this, does it have to start with batteries? Does it have to start with other components? And is it actually inward investment coming into the UK?
Yeah, I think batteries are key. So if you look at UK production, 30% comes from Nissan. They have a gigafactory and they're expanding that. So they have production in place for the transition. GLR accounts for 30% of UK production. So if press speculation is correct, the next gigafactory from JLR will come to the UK. So that would be a massive positive for the UK and would accommodate 60% of their battery needs in the future.
Yeah, but Michael, so JLR is owned by Tata. They're looking at doing an agreement with the UK. How much of a struggle is it if it doesn't come through?
Yes, a massive struggle if it doesn't come through, because they do need these batteries. Yeah. And because of these rules of origin, it's going to be an issue, and they will become uncompetitive if they're going to sell to Europe in the future.
But again, and I know this is a difficult question, but to you both, do they need this deal to, for batteries and automotive, or do they just need it so that it says, look, Britain is open for business?
A bit of both. So, subsidies are key. So there's been huge headlines about the Inflation Reduction Act in the US attracting battery plants over there from EU companies. So subsidies are key, and the UK government has to back UK businesses in terms of battery production, and that should be the case with Jaguar and Land Rover.
Okay, is it looking good? I mean, the government, again, we have a government that's a little bit in a tricky situation because they have to fight a lot of fires, and we're not sure they're in charge for much longer.
I think what we absolutely need, just to follow up on what Michael's talking about, is an industrial policy, and that's something that we've consistently heard from car maker executives and current and former, that the UK lacks an industrial policy to justify keeping production here, especially in light of the Inflation Reduction Act that really sort of raised the stakes and is going to force the hand of the government to really step up and support and save this industry.
At the same time, I guess, you know, the industry that was really in doldrums during COVID has not only recovered, but luxury sales of cars are doing really well.
Yeah, and I do think that there is absolutely a place for companies like Aston Martin and Bentley to maintain production in the UK, even if it means even if we are unable to attract much battery investment. We've heard Bentley talk about, you know, being able to tap Volkswagen's supply chain, you know, using batteries from mainland Europe that would apply to that rules of origin and help hit that threshold, and you know, not necessarily need to localize battery production here and still maintain their presence in Crewe as well.
I mean, it's amazing, actually. It does employ 780,000 people in the UK, this industry. It's a lot of people. And if you look at, of course, the targets that the UK has set, Michael, you know, the UK wants basically to be hybrid by 2030 and then completely electric by 2035. I mean, that's a huge amount of cars that need to be made and then driven.
Yeah, it's going to be very difficult. You've already seen the EU dialing back, or some EU countries dialing back on when they're going to ban the combustion engine. In terms of BEV market share, it's about 15% in the UK. That compares to the 13% in Europe. So we're still a long way away from this being an issue, certainly not in the next few years, but certainly in the second part of this decade. We need better battery supply, but we also need better charging infrastructure. So that could be another part of the puzzle that's holding the transition back.
I mean, that seems hard, right? Because I don't know how long it takes. First of all, you need the copper and the things to make it. And again, we don't have an industrial policy, and the Chinese have really thought about this, maybe more than G7 countries. But two, how long does it also take to put these charging stations in place?
Yeah, it takes a long time because you need the people in place, you need the finance in place, you need planning permission. They're very expensive. So globally, there's 2.7 million public chargers in place, only 600,000 in Europe. We think you need 2.5 million by the end of the decade if we're to meet government targets. So they've got a long way to go, and we're probably putting in about 150,000 chargers at the moment. So that needs to double if we're going to meet these targets by the end of the decade.
So industrial plan now is basically the call for action for the government, right?
Yes.
We just need an industrial plan.
Yes, and it's long overdue. I do think that some of the warnings that we've heard recently, maybe one sort of silver lining of this, you know, talk about, you know, doom and gloom will sort of wake up leaders to this idea that, you know, they can't continue to allow this industry to languish, and do need to come up with an answer to what the IRA, what's happening with the IRA, and in the EU to answer the IRA from places like France and you know, the rest of Europe.
Such an important conversation. Thank you both for joining us. Bloomberg's global car czar, I love saying that, Craig Trudell and Michael Dean from Bloomberg Intelligence. Now, speaking of an industrial plan, we're also getting UK manufacturing PMI coming in a little bit better than expected at 47.1. Remember, anything below 50 is still in contraction territory, and UK firms are expected to raise prices some 5% in coming year. That's the very latest forecast from the Bank of England. Coming up, batteries and Brexit. We'll talk more about the state of Britain's electric vehicle industry and why the UK is being overtaken by others. This is Bloomberg.
Tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harness Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Bloomberg.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Welcome back to our deep dive on the future of the UK car industry, of course, in particular, electric vehicles. Now, joining us now is Caspar Rolls, Chief Data Officer at Benchmark Mineral Intelligence. We love a data guy because this is what we do at Bloomberg. So you track and measure and actually see where the soft spots or the blind spots of the UK government are. How are we doing on electrifying some of the batteries in the car industry?
Yeah, good morning. Thank you. Yeah, in terms of the UK government, we're not doing too well. We've really lacked proper, let's say, electric vehicle or lithium-ion battery policy so far. And when we look at other countries in particular, not just in Europe, so in Europe, Germany, Hungary have been doing very well at attracting investments in the lithium-ion battery supply chain, but other global regions as well, particularly Asia and China.
But so is it too late? And is it actually a lack of capital? So it's a lack of big investors? We know that Bill Gates, for example, is giving a lot of money in the West Coast to try and get this done. Or is it a government policy?
It's probably not too late, but to catch up, you need to put more money on the table. So the UK needs to, or the UK government needs to show support for a full lithium-ion battery supply chain. I mean, to date, so far within Europe, a lot of the focus has been what we term the downstream, so kind of the battery in the electric vehicle. But also we need to think more about the upstream, the critical minerals. So where are you going to get those minerals from? Can you do that in the UK? Probably we won't be self-sufficient. So thinking about partnerships with other regions to get the minerals to feed the supply chain and all those plants.
So, Caspar, is it the model of, for example, Germany? Do you have to grow this in-house? So do you have to have, UK technology? And we know that we have top universities, so we could be able to do this if you put enough capital behind it. Or is it about the UK government attracting, for example, Elon Musk to have a factory in the UK?
It's a mixture of both. You definitely want to attract what we would term at Benchmark the Tier 1 cell manufacturers. So there's actually only kind of 9 companies globally which can supply electric batteries into every global region, electric vehicle batteries into every global region. So you need to kind of bank on those companies, the ones with the experience and the technology to supply EVs. It's very challenging to get to that quality, but also homegrown talent as well. So supporting industry, supporting new UK companies which are looking to develop battery technology.
What I also don't understand is some of the earths or some of the metals needed. It's copper, it's certain parts of like iron, I think, I mean, things that actually British listed companies do, right? Glencore is very present in the space. You have BHP.
Yeah.
Is that a missed opportunity in actually trying to do some of these deals, or does it not make a difference where they're listed?
It probably doesn't make a difference where they're listed, just because these critical minerals are going to be in such short supply. So primarily that's lithium, and that comes from various different global regions, and therefore you get many different types of companies.
Mainly China, right? I mean, they locked and loaded that.
Yeah, so lithium chemicals, a lot of lithium chemicals come from China, but that's the refined type of lithium. A lot of kind of the lithium in the ground, let's call it, comes from Australia and South America. But also you need other minerals. You need nickel, you need cobalt, manganese, you need iron phosphate for LFP batteries. So it's very important to ensure that you can either support industry to go out and acquire those minerals, or, the main way would be to attract companies who buy them and ensure that they're going into the plants in your region.
So, Caspar, if you're the UK government now, and of course you're dealing with the Inflation Reduction Act in the US, where we're also seeing possible a lot of investment into greening the automobile sector going stateside, and you have, of course, the plan of Ursula von der Leyen in Europe, you need to be better and bolder to make sure that investment comes here.
Yeah, you need to compete at that level, and the amount of money that's been put on the table for the Inflation Reduction Act in particular by the US government is a scale that we've not seen before. It's many hundreds of billions, potentially trillions of dollars that will be in terms of support for a full lithium-ion battery supply chain from the mining, the critical minerals, through to recycling. So it does up the ante as as the UK government looks at this, but as I say, it's probably not too late, but something needs to happen, in the very near future to ensure that it isn't too late and we don't lose those existing jobs which are tied to the auto sector in the UK.
Are we still in the infancy of batteries? Is it what like solar panels were 15 years ago?
Yeah, I mean, definitely in terms of the scale, we're in the kind of Ford Model T era of the lithium-ion battery supply chain, so at the very bottom of the hockey stick curve. So yeah, there's still time. The demand for these batteries is going to be growing something like 25% CAGR beyond the end of the decade. And so there's a lot of scope to build out the supply chain in that time frame, but it becomes more and more challenging as time goes on. And those kind of very sticky strategic relationships between the car makers and the battery makers get cemented over time.
But it's also the technology, right? How much is the technology changing? I know that and how you recycle them, like the whole ecosystem, how much of a question mark does it still have?
Yeah, I mean, definitely the technology is changing all the time. So the lithium-ion we have today is better than the lithium-ion we had
5 years ago, I guess.
Yeah, or even 2 years ago. It changes very quickly. But, that it's changing with consumer needs. So there's still a lot of scope to see the supply chain change, the technology change that we use in the vehicles, and then next-gen technology as well. So you always need to have one eye on the future of the kind of next type of batteries that will be going into EVs and storage as well.
And Casper, when you look at the data, consumers want this, right? Like consumers are, I guess, are ready to buy the cars as long as they have the infrastructure.
Yeah, I mean, yeah, the infrastructure is important. Obviously, there's range anxiety, so having access to charging, but also, what's challenging is we've seen prices for critical minerals, at the peak last year, lithium prices were 10x where they were just before the pandemic. So it's also managing costs. So being able to build out that scale to keep costs low, to enable more consumers to be able to afford electric vehicles. At the moment, they're still relatively expensive.
Casper, thank you so much. Casper Rolls, their Chief Data Officer at Benchmark Mineral Intelligence. Now, coming up, Made in Europe, we'll ask what the EU is just doing differently to the UK to get ahead in the EV battle. That's next, and this is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, this morning we've been exploring the state of the UK car industry, threatened by Brexit trade rules and at risk of falling behind in the switch to electric. Now, while the UK has only had a handful of battery plants, Europe has at least 35 up and running or under construction. Well, let's bring Bloomberg's Elizabeth Berman from Munich. Elizabeth, good morning. Why does Europe seem to be so ahead of the UK when it comes to batteries?
Yeah, it's a bit of a relative question. If you look at the UK, they've been distracted since 2016 with Brexit. There's been a high-octane political drama, successive business secretaries, successive transport ministers. So there's not really been much of a line on developing an industrial policy. And when you compare that to Europe, you have to look back to around 2018 when the race and this realization to try and close this huge gap in the value chain in EVs, that really started to take shape then when France and Germany formed an alliance. And the whole thing became an election issue even in Germany, like this push to build lots of battery plants. And then it reached the EU level and things started to take shape. And today we're really seeing the first fruits of these in the shape of actual plants that are producing, that are up and running. And just this week in northern France, Stellantis, Mercedes and Total inaugurated the first stage of their plant there. And then we also have in Sweden Northvolt, which is up and running. But this makes it looks good versus the UK. Versus elsewhere, Asia, there's still a lot of catch-up to be done.
But a final thought then, Elizabeth, maybe on the post-Brexit trade rules. The Stellantis chief executive has called them a lose-lose situation with both the UK and the EU. Why can't the two sides work out a solution?
Well, first of all, Stellantis is right. The European supply chain is not ready to meet these rules of origin. It's also to do with rising raw materials prices that are making batteries even more expensive. And in terms of trying to find a deal, as we've heard, the car industry is very much united in pushing out the threshold level to a later date. From the UK, we've heard the same. Where we've had notable silence so far is from the EU Commission. I can't speculate on their readiness to reopen the deal on this, but there are, of course, also a lot of smaller states in the EU that might want to benefit from multi-billion investments, notably Hungary or Slovakia, where you already have lots of car plants.
Elizabeth, thanks so much. Bloomberg's Elizabeth Berman there on the EU side. Now, be sure to subscribe to Bloomberg's In the City podcast, also that I host alongside Dave Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. Every Thursday, new episodes.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. New inflation data this hour may determine whether the ECB keeps hiking interest rates. Meanwhile, Fed officials say they're in favor of a June pause, but more hikes could follow. The US debt limit deal moves to its next phase. The deal now heads to the Senate after winning House passage in a rare moment of bipartisan accord. And AI enthusiasts getting a reality check as shares of Nvidia and other major players slip after a powerful rally. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie, stepping in for Anna Edwards in London with Kriti Gupta, of course, in New York. Kriti, a trifecta then of positive catalysts, at least for now. Slightly better than expected China data. The Fed, of course, hinting, at least some officials, at that pause in June. And then the debt ceiling deal getting past the hurdle of the House.
Yeah, the focus shift that you're seeing so quickly from this idea of the debt ceiling no longer being the macro narrative to very quickly going back to the fundamental story of growth, that is showing up in the markets all around the world, I would argue, especially when you're talking about the momentum behind futures. That defensive bid that you saw in the tech space kind of simmering down just a little bit. Futures up still about 0.2%, but again, really lacking that conviction. And if you look cross-asset, you are seeing similar signs. Again, the idea of that is inflation really fully targeted to the full extent by the Federal Reserve, and how much further do they need to go? That sentiment really showing up in the bond market. Two-year yield hitting 4.44, inching closer and closer to 5%. So really speaks back to that question of what is the terminal rate at the end of the day. Already seeing a 5 basis point move higher. So some bond volatility before trading has really even fully kicked off stateside. Bloomberg Dollar Index taking a little bit of its cue from what's going on in yield, about unchanged at the moment. But remember, earlier in the session, really tick by tick following what the bond market was telling it. And of course, Tom, as we talk about that de-risking around the world, perhaps gold not really the trade du jour. You are seeing the precious metal down today, down about 0.3%, trading at about 19.55. If you were worried about inflation, if you were worried about a recession, you would think the commodity space would get a bigger bid. And yet, Tom, we're just not seeing that.
Well, on those inflation concerns, the redhead's crossing right now. We've been waiting for this in terms of Eurozone inflation, and the headline number coming in slightly below the estimates. But the importance around core inflation and that print as well coming in slightly lower than the estimate. So this is good news, at least on the level, at least on the surface level for the ECB. We'll have to have a look to see if there's a change in terms of market pricing around the next steps. June seems pretty certain in terms of another hike from the ECB, but really there is a question mark over July. So May consumer prices for the euro area then coming in at 6.1% year on year. The estimates were for 6.3%. And here's the core number then, 5.3% year on year. The estimates for 5.5%. So 5.3% year on year for core, below the estimates of 5.5%. And again, it does suggest that inflation is heading in the right direction, even as those ECB officials say there is more work to be done. We will check in on the market moves then with a particular focus on the euro dollar and also those sovereign bonds. Across the equity space, you have seen an uplift, snapping 3 days of selling pressure across European equities. You're gaining 0.9% across the benchmark here now. Part of that is the China data, the Caixin survey. It focuses on private and smaller companies, and it's diverged from the official picture. So it's a mixed picture when it comes to China data, but for the moment there's a bit of relief, and you're seeing that in sectors like autos, and that's certainly lifting European stocks. Euro dollar 106, it's flat, but you're at levels last seen since March for the single currency. Anglo-American, we pulled this out for you because of the lift that we're seeing in terms of copper and iron ore prices, again tying to the China data, gaining 1.7% on the back of that. And Doc Martens, it's an idiosyncratic story really, but this is the famous shoemaker here in the UK, the bootmaker. Full-year earnings estimates coming in, full-year earnings coming in below the estimates, and a cautionary note from the analysts that maybe the peak for this brand has been baked.
Again, is not that surprising when you look at the data that we had from a number of national prints yesterday. Obviously, yes, both numbers are still above the European Central Bank, but what really matters is the trend here, and it points to a cool down, actually better than expected when it comes to the survey, this cooling down in May. Now, the real issue here, especially when you look at core and headline inflation, what the European Central Bank really wants to see is this determination, the monetary policy, this hiking cycle, the most aggressive since the creation of the euro, is now really feeding through on a persistent medium-term basis. That this is not just connected to energy. What we've seen, and we've seen this repeatedly over the past few months, is that as soon as energy prices go down, headline inflation follows. But what they want to see is almost this intrinsic proof that this is sustainable and will put inflation now on a more medium-term direction to hitting that 2% goal. Overall, of course, the numbers, you could argue, it is welcome news. It will point to this cool down. We know there is a meeting in 2 weeks' time, and the data will be key. The European Central Bank repeating now many times it is mega data focus. They focus on the pass-through of monetary policy too, and they really monitor that core print coming in at 5.3% for May.
And of course, that data key focus for the ECB's next meeting coming up on June 15th. Well, Bloomberg TV had a very special guest earlier on air. We spoke exclusively to former ECB President Jean-Claude Trichet earlier to mark the central bank's 25th anniversary.
25 years is a quarter of a century. And we started the ECB and the euro in an environment of great pessimism. As was said a moment ago, it was the, I would say, boldest endeavor. I would not say experiment, because it seems to me it's much more than an experiment, but the boldest endeavor in that domain.
Well, the boldest endeavor, Maria, working out, wouldn't you say? Talk to us about what the ECB is going to do with all the data this morning.
Look, and on top of the data, by the way, that we got today, the ECB is expected to put out new projections in June. So that will also be important in terms of the narrative here for inflation. And look, today we heard again from the Vice President of the European Central Bank, Luis de Guindos. He was also on Bloomberg TV yesterday and repeated at this point, the ECB has probably entered what is the final stretch of this hiking cycle. It's also notable that he did say it does seem that at this point, and this is his opinion, obviously we know the Governing Council entails a number of views, but he says in his view, in his opinion, 25 basis points will be the new norm going forward. Again, this downshift has already happened. There was a question as to whether it would be sustained. In time, the words from the VP of the European Central Bank would signal that, in his opinion, yes, from now on, it is 25 basis points. Now, when it comes to the meeting in June, the market is very well calibrated that there will be another hike, but the serious question is what happens next? How many more hikes could be to come if the ECB decides that should be the way, or actually, if you look at the market, some of the cumulative basis points hikes that were priced in, the 50 basis points, that reverse a touch yesterday, signaling there is now an open debate as to what happens after June.
Yeah, a question that we are starting to explore stateside as well. Maria Tadeo over in Brussels, we thank you as always for walking us through that crucial data. And from Brussels, we come right back to Washington. The House has passed the debt limit deal created by President Biden and Speaker Kevin McCarthy that would impose restraints on government spending through the 2024 election and avert a destabilizing U.S. default. McCarthy spoke after the vote last night.
Tonight, we all made history because this is the biggest cut and savings this Congress has ever voted for.
Joining us now, Jack Fitzpatrick of Bloomberg Government. Look, a historic moment over in Washington. Jack, what comes next? Isn't the true hurdle in the Senate here?
Not necessarily, no. I think the true hurdle was getting a deal between the president and the Speaker of the House, and then the assumption was always if you can get a Democratic president and a Republican speaker to get a handshake deal, you're probably fine in the Senate. It needs 60 votes in the Senate. I guess the last remaining test is not so much the Senate whip count, but the timing of a Senate vote, because this is a chamber that moves slowly unless it has unanimous consent for a time agreement. If all 100 senators agree to schedule a vote before the Monday deadline, then we're in good shape. So there are a few senators talking about what they might want in terms of amendment votes or something else in order to agree to a speedy vote. We haven't heard from anybody who seems like they're going to try to burn the place down, but there are probably going to be some amendment votes that are destined to fail. And even some, for example, Senator Lindsey Graham says that in order to give permission for a quick vote, he wants answers about the possibility of further defense spending that goes over the caps set in this bill. So Congress is already trying to find ways around the spending constraints. But long story short, it does not seem that anybody's going to try to delay a vote. And it does seem to be in pretty good shape heading toward a Senate vote.
So, Jack, as the dust appears to settle on this deal, who comes out best? Who is best burnished or indeed wounded by this deal?
Nobody's terribly happy, which is probably a good sign that it is a true compromise. Republicans got more out of this than Democrats, certainly. This is a list of things that conservatives wanted. It's not as conservative as they wanted, but they managed to get some spending constraints in a Democratic administration. They managed to tighten some work requirements for SNAP nutrition aid eligibility. There's really nothing particular in here that Democrats proactively wanted that they got. Although if you compare it to the original Republican bill, there were a lot of concessions made from Republicans just in terms of fewer spending caps, fewer spending cuts. So it's certainly a compromise, but it's one based off of Republican principles.
Well, Jack, we know that in the short term, things look like they are just fine. But of course, this is going to then push ahead to the 2024 presidential election and what comes right after. Talk to us about, in about a year and a half's time, January 1st, 2025. This feels like yet another big issue for whoever decides to, or whoever is elected to office. Jack, talk to us about the long-term debate on the debt ceiling as just kind of a function of this saga that we go through every couple of years. What is the feeling in Washington about whether it's even useful?
A lot of Democrats would like to get rid of it. That's probably the mainstream position among Democrats. They have not had enough support to get rid of it, or at least they didn't have enough support to get rid of it when they controlled both chambers. I think people like Senator Joe Manchin generally seem to think that a spending cap deal like this through the debt limit is a good thing. But many Democrats would like to get rid of it. Some Republicans are interested in maybe tweaking the process so it's a little bit less focused on brinkmanship and getting us close to a deadline. So there are some big questions being asked, but really it's been a number of years that Congress has questioned itself about its budgeting process, about the debt limit, and they have not made major changes. So that's something that's simmering. I don't know if this fight brings it to a full boil, but there are questions being asked about whether lawmakers really want to go through this again.
Okay, Jack Fitzpatrick on this bipartisan deal and looking ahead to some potential challenges that may rear their heads once again when it comes to US politics of Bloomberg government. Thank you. Now to the tech space, and Nvidia losing some ground in the pre-market after a record, of course, AI rally. Some investors have expressed concern over high valuations. Joining us now to discuss is Bloomberg's Alex Webb. Alex, do we get the sense of a wry smile forming on the lips of Cathie Woods? What do you make of this?
It is interesting because actually this $1 trillion market cap number, which is kind of, an invisible hurdle, doesn't necessarily mean all that much. We've seen something similar when other companies have tipped it. When we've seen Amazon get to $1 trillion for the first time, Apple go to the first time, we saw a bit of a sell-off in the day or two. So following that, it appears to be a certain amount of profit taking. If you look more broadly, though, at AI, people aren't quite sure how to read it. Is NVIDIA the best play and it's still got lots of legs in it? It's quite hard for anyone to tell because we don't quite know how demand is going to materialize as we head into next year and year after. But also, they've been burned before when it comes to things like crypto and Web3. This feels like a different set of technology where it has immediate applications that lots of people can see, but there's a bit of hesitation.
And we should talk about another major tech name, and for those of you who kind of watch the Dow, specifically a major Dow component, Salesforce, Alex, also edging lower in the pre-market. Their results disappointing investors. We didn't get that traditional artificial intelligence phrase dropped in anywhere that we did for some of these other tech companies. What's the story with Salesforce?
It's a fascinating equity story at Salesforce because we've really seen them pivot away from being a growth stock and focusing on profit. And the number that seemed to have disappointed investors, particularly yesterday, was what the company calls current remaining performance obligations. Essentially, it's its order book in the broadest sense. And that was a little bit low what the market was expecting. We've seen the valuation as a multiple of its blended forward earnings for Salesforce come down, even as the stock has remained relatively robust. But, in sort of 2019, 2020, it got to 70 times its forward earnings. It's come right the way down to 29 times its forward earnings. But that's partly because the earnings themselves have come up massively. There's a real focus now on profitability. They're not investing profits as readily in gaining market share. And perhaps there's a little bit of a hesitation from some investors who were still in a growth stock and not necessarily in what this stock is now becoming.
Okay, Alex Webb on Salesforce and NVIDIA, of course. Thank you. Now, coming up, we're going to speak to Royaka Ibrahim of BCA Research on why she sees a potential monetary policy mistake looming in Europe. And The View from Lazard. Peter Ozug says, do not bet against America.
I would not short the United States. There are a lot of ongoing strengths that we have despite a very polarized political environment.
More from our interview, of course, with the incoming CEO of Lazard. That is ahead. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
I am in the camp increasingly coming into this meeting thinking that we really should skip, not pause.
Skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming.
Okay, that was Philadelphia Fed President Patrick Harker and Fed Governor Philip Jefferson. Let's bring in Bloomberg Markets Live editor Noor Al-Ali. In the context, the importance around, of course, Jefferson is that he's seen as something of a wingman for Jay Powell, who previously, earlier in the month of May, suggested that June was going to be a pause. That idea, that debate now seems to be solidified. You're going to get a pause in June. Is it going to be a hawkish pause? And where do you expect the next steps to be?
Well, it really depends on the jobs data, right? I mean, we are seeing, or it's expected to moderate slightly, but it's still quite healthy in terms of an economy that needs to still see jobs the jobs market become less hot or less tight as it is right now. You also still have, core inflation still very much higher than the Fed's target or where it's comfortable with. And keep in mind, we have the lagged effects of monetary policy really starting to seep through. We've got the most aggressive tightening policy from the Fed since the 1980s. It's going to take some time. So a pause, although that is starting to seem like a campaign from the Fed, isn't it? It seems a bit more in line with what they're trying to get the market to position themselves for. So let's see if the market bites.
Well, speaking of biting, I mean, the market has been pricing in cuts for a very long time, now pivoting to a hike. But it feels like at the core of the story is this growth idea, something that's reflected very largely in the commodities market, specifically stateside as we look at NYMEX crude, for example. I think we've got a term for our radio audience. You can find this on GTV Go on your Bloomberg terminal, essentially showing that you are looking at WTI falling below $70 a barrel, and it's kind of been there for, I want to say, the last 6 months or so, really testing that level. Nor, when we're talking about growth concerns, where does the investor base really stand?
Well, look, for oil, it's really complicated, right? I mean, oil was very much the inflation story after the pandemic. You also had, OPEC plus globally and the global benchmark really contribute to that tightening supply picture. But also now you have that straining of potentially the supply picture or the demand picture out of China. We've had factory data earlier out of China, point to initially some kind of recovery, though the recovery in China is still very much in question. Obviously, you've had diesel really struggle as well. Natural gas supplies and all that stuff really has taken a hit because you've had a milder weather. You've had, the trucking industry still very much subdued. So that seasonal tick in demand that you would particularly expect this time of year is not really there. So all eyes are really turning now to OPEC. They're meeting, this weekend. It's going to be a very exciting time for the oil market. Will they be able to support the market? And if not, what does that mean for prices? And I think that's something that the market is positioning themselves for.
With Brent at $72 a barrel, WTI at $68 a barrel, and that Goldman Sachs call of $95 a barrel by the end of the year looking far away. Noor Al-Ali, thank you very much indeed on the commodity complex and rates as well. For more market analysis, of course, check out MLive Go on your terminal. This is Bloomberg.
source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Now keeping up to date with news from around the world, here's the first word. Ukraine's capital was hit by missiles overnight. Kyiv's mayor says at least 3 people were killed, including 2 children, by debris. NATO foreign ministers will discuss Ukraine's bid to join the military alliance at a 2-day meeting in Oslo today. Meanwhile, Ukrainian President Vladimir Zelensky made an unexpected appearance at a summit in neighboring Moldova. The summit is taking place less than a dozen miles away from the breakaway region of Transnistria. Zelensky says he will hold bilateral meetings at the European Political Community Summit, where he will propose setting up a, quote, coalition of patriots. Elon Musk's private jet has departed Shanghai, wrapping up his first visit to China since the pandemic that included meetings with senior government officials and a late-night visit to Tesla's Shanghai Gigafactory. In a video released by Tesla's China team, Musk was shown waving to the workers, then thanking them for being at the factory late at night. He also congratulated the staff on their, quote, amazing work. Coming up on the program, Ruqayya Ibrahim of BCA Research joins us next. We're going to talk about everything from these markets to the economy. Very quickly, did the focus turn from the debt ceiling debate to simply the idea of growth, of inflation? Is the fight of inflation really over? We're going to ask Ruqayya and get her insights on just how to play this market. Stick with us. This is Bloomberg.
So most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Euro area core inflation eases, though the retreat is unlikely to stop the ECB from raising interest rates further. Meanwhile, Fed officials say they're in favor of a June pause, but more hikes could follow. The U.S. debt limit deal moves to the next phase. The deal now heads to the Senate after winning House passage in a rare moment of bipartisan accord. And AI enthusiasts get a little bit of a reality check as shares of NVIDIA and other major players slip after a powerful rally. I'm Kriti Gupta in New York with Tom McKenzie stepping in for Anna Edwards over in London. Look, Tom, the kind of debate around the markets in terms of what is actually driving the macro narrative is crucial. We went from debt ceiling to growth. Is that what you're seeing in Europe as well?
Well, certainly the data out of today for Europe is looking a little bit more favourable. Manufacturing data for the likes of Germany and France came in a little bit better than expected. And as you said, inflation is moderating and importantly around core. So for today, at least, it's a little bit brighter in terms of the data. And then we're snapping 3 days of losses across European equities as we also weigh up the optimism around China. It's a bit of a mixed picture, but the smaller survey, the survey focuses on those smaller businesses, the private businesses, the Taixing survey came in better as well. So that's also fitting into the uplift across European stocks. 0.88%, euro dollar 106 as we weigh up the next steps for the ECB. As Maria Tadeo has been explaining, June seems pretty baked in, but it's July that remains the question point now. In terms of the lift that you're getting from the China data, that's certainly been seen in copper and iron ore. The last time I checked, iron ore prices were up about 4%. So that's a benefit for the likes of Anglo American and the other miners, gaining 1.8% on the back of that. UniCredit, the banking space, the banking sector, really leading the charge as well. One of the leading, if not the leading sector in the session this morning. UniCredit is part of the mix there. It's also received an upgrade. 2.9% is the upside for that Italian lender. Kriti.
And certainly some sentiment you're seeing kind of bleed into the stateside story as well, Tom, because you are seeing green on the screen when it comes to futures, but I would argue with just not as much momentum as you're seeing on the other side of the Atlantic. Futures are higher by about 0.2%. And again, to your point, it does speak to the idea of, all right, well, is the fight on inflation over? But I have to say there's an extra dimension to the U.S. story, which is the earnings story. Specifically, as we talk about those growth concerns, now we're starting to kind of nitpick through the earnings story of companies like Salesforce, for example, a major player in the S&P 500 and the Dow, and just how much growth and just how much business investment you are seeing from some of these major corporate players, especially in the light of the big AI kind of craze that we just saw in the markets, justified perhaps by some of the money going into that. So that's going to be a theme we explore in just moments. Two-year yield, 444. You are starting to see yields come higher, again, talking about the inflation story and just how hawkish the Federal Reserve could get as the market kind of prices in a July July hike over a June hike. So that's going to be interesting. The pause or skip debate coming back to the forefront. The Bloomberg Dollar Index, at least directionally, following the story of yields, although on the surface unchanged at the moment. So really keep an eye on how that speculative positioning in the FX story really has a ripple effect, not across just equities, but across commodities as well, specifically in gold, where we are seeing some of the momentum kind of ease now that the debt ceiling debate is in theory over. 1958 on the precious metal, Tom.
And just looping back to the inflation story out of Europe, Madame Lagarde, of course, the president of the ECB, a couple of lines at a speech that she's giving right now. Inflation is too high and is set to remain so for too long, says Madame Lagarde. Still have ground to cover on rates. So a reminder that they do believe within the ECB Governing Council, we know this is a live debate, but you are hearing uniformity in terms of the need to go a little higher. The question is how much higher, and is July still in play? Let's bring our next guest then, Ruqaiya Ibrahim, Daily Insights strategist at BCA Research. And Ruqaiya, thank you for joining us. I want to start and look back to DC and the politics of the US. Let's assume, if we can, that the debt deal has been done. It's past that crucial hurdle of the House. It goes to the Senate. But if we can make the bold assumption that it's a done deal and switch our focus to the issuance then of what some are estimating is potentially $1 trillion of debt from the Treasury to refill those coffers. How does the market absorb that? What are the strains that you're looking for?
Yeah, well, definitely the deal does remove this uncertainty that has been haunting markets over the past few weeks. So that's definitely positive, and it's going to be positive for risk assets. But I think the overarching picture here is that, I think the focus is going to quickly shift to, the macro context, which is still that inflation is too high, that the central banks are still, monetary policy is still restrictive. And that's the overarching macro picture that is going to weigh on markets going forward. Now, in terms of bond markets, I think that what this means is that the continued tight monetary policy. The Fed most likely is not going to hike in June and probably not in July as well, but it's very unlikely that it's going to cut interest rates at the second half of the year. We've seen markets, remove their pricing of those rate cuts in the second half of the year, but that's going to be something that's going to continue to weigh on equities. And at the same time, it implies that bond yields are most likely going to be range bound for now until we see a greater deterioration in the labor market data, which is then going to lead to the next leg down in bond yields. So I think that's really what matters in terms of bond markets is, what's going on with the central banking.
And the markets have faded those expectations of cuts by the end of the year from the Fed. Does that store up, though, as we look ahead to 2024, Ruqaiya, does that store up just more cuts that have to come through next year from the Fed?
I think it really depends on what we see in terms of the economic environment. And our base case is that we are likely going to see a recession going into 2024, perhaps in the first half of 2024. And if that's the case, then the Fed is going to definitely, turn to easing. Now, the good news here is that so far what we've seen in terms of the labor market, and this was confirmed by the JOLTS report that we got yesterday, is that the labor market has been quite resilient. So it's, it's been that a lot of the weakness has come in the form of lower job openings rather than a rising unemployment rate. Now, the question going forward is this trend going to continue? If it does, then it does not necessarily necessitate too many rate cuts from the Fed. But if we do see a greater deterioration in the labor market, which is our base case, at the end of the day, the unemployment rate is a mean reverting story, implying that as it begins to increase, it's going to continue increasing. And that likely means that the Fed is going to have to cut interest rates more aggressively next year.
Well, Ruqaiya, let's talk about that kind of thesis of cutting interest rates. If we're of the consensus opinion that this recession in the U.S. and potentially globally is going to be a shallow one instead of a more kind of traumatic one like 2008 or 2020, does that really require that kind of easing from the Fed, given that we're coming off of over a decade of kind of this easy monetary policy? Is there an incentive to perhaps not cut at all?
I don't think that there is an incentive to not cut at all. I think that, the Fed has hiked interest rates by 5 percentage points over the past year or so. And so I think that there's going to be an incentive to bring down rates to a more reasonable level. But, I do agree that, that what we're seeing in terms of the likelihood of a recession is a high likelihood of a recession, but not necessarily a very deep recession. And if you take a look at what's happening, for example, in the housing market, the housing market is quite healthy. It's actually rebounded quite a bit since the beginning of the year. And so that suggests that there's no really imbalances there that could be a strong risk for the economy.
Rukaya, so a higher kind of likelihood of recession. But for the equity market, the concept of recession has come and gone. We've also already seen an earnings recession, a technical recession, you name your metric, but they're already looking ahead. Talk to us about the green on the screen we've been seeing specifically in the U.S. stock market. Is this the start of something more sustainable?
You know, what's very interesting is what we've seen year to date is that the rally has been, of course, extremely narrow, bolstered by enthusiasm about this generative AI theme. You know, that could have longer term, longer term optimism on that front could be justified. But, you know, it's probably gone too far from here. And the question is this rally going to broaden out? Most likely not. And, you know, what we saw from the earnings season that you just mentioned is that even though earnings generally surprised to the upside, the reward that equities gave to these upside surprises, which was much smaller than they were in the past, and they penalized the disappointments much greater than they did in the past. And I think that just highlights the uncertain economic environment that's highlighted by, for example, leading economic indicators, the inverted treasury curve. These are all signaling that the recession risk is still ahead. Now, what's very interesting is that analysts are expecting earnings to be to rebound in the second half of the year. However, if you take a look at economic expectations of what's going to happen with GDP, they're expecting GDP to contract in the second half of the year. And I think that there's a mismatch that needs to be resolved there in terms of, is earnings going to rebound, earnings growth going to rebound, or is the economy going to deteriorate? And, you know, my own personal opinion is that it's going to be the latter. I think the economic environment is going to deteriorate in the second half of the year, and that's probably going to bring earnings down with it.
Okay, Rukaya Ibrahim of BCA Research, thank you very much indeed, flagging that split, that divergence between the forecasts on the economy and the projections around earnings, the mismatch, and how that could be a point of concern. Thank you. Coming up, the view from Lazard. We're going to take stock of the investment banking landscape. That is next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
We've known for a long time that there is a long-term fiscal imbalance facing the United States. So far, it has not caused acute crises, but instead is one of these kind of termites in the foundation type of issue where eventually it will catch up with you.
Incoming Lazard CEO Peter Orszag speaking to Bloomberg's Shonali Bassick yesterday. And speaking of our Wall Street correspondent, she joins us now to take us through some of what's going on in the investment banking landscape. Look, one of my favorite comments from Peter Orszag was, "Don't short America," of course, coming from the American. Let's start with the banking story. What do we know? What do we learn? He has a really unique perspective on that part of the world.
Yeah, he really does, because Lazard has not only a sovereign advisory practice, but they have now also a geopolitical risk advisory practice. And I think that's really interesting, because we are still talking not just about decoupling supply chains or doubling down on certain regions or how to navigate places like China in particular. But, you know, the interesting part of this, too, is you have investment bankers scraping the entire globe for where capital comes from, as well as what is the next leg for deal making. He spurred some optimism also in Europe. And remember, Lazard is one of the bigger independent investment banks in Europe. And so that is another spot where, you know, the economy is showing promising for deals, particularly also private equity deal making, because of not only attractive valuations, but just kind of things kind of coming up to market and open capital markets as well.
I'm glad you brought up the regional kind of bifurcation there, because of course we know deal making in Asia has slowed down a little bit. You mentioned Europe specifically. Is that a temporary situation? Just how bad is the environment when it comes to deal making globally?
Yeah, you have to kind of bifurcate types of deal making. So Lazard is a classical investment bank focusing on mergers and acquisitions. And we talked to a lot of investment bankers this week. So this is a really nice time to take stock before the summer kind of starts off here. Citigroup is another good example of this on global deal making. We talked to Tyler Dixon, who runs their banking capital markets advisory business. And across the globe, he's saying, you know, he's going to China too. A lot of questions, a lot of promise there. But it is too soon to tell when M&A in particular will come back. I think the league tables for the last 12 months is really interesting. Goldman's still on top of the last 12 months. But if you take a look, JP Morgan on the year so far is in the lead. Goldman has been the biggest investment bank on mergers and acquisitions for the last several years, really. So the competition is interesting. One of the biggest deals on the JP Morgan league table this year is Toshiba. So that international footprint is super interesting when you take a look at what's going on. They also have Newmont and Qualtrics. So a lot of competition, Critty, but not a deal market that has come back at scale for M&A. A little better when you look at debt capital markets, investment grade and high yields. High yields, Goldman is leading the pack and has risen on those league tables.
So Shonali, that's the picture in terms of deal-making, M&A underwriting. When it comes to the spend on AI and how we tie the AI story to the banking space, the investment banking space, it wasn't that long ago. Well, it was early, 2022, I seem to remember. JP Morgan was getting hammered by some analysts for its massive spend on tech. Is that now paying off for JP Morgan?
It's a good question, because if you look at the jobs that are open, Tom, a lot of them are AI and technology related. And if you think about it, it's an interesting pivot from investment banking, because there are a few banks that use AI and other kind of quantitative techniques, really kind of a lot of other technological techniques, Goldman being one of the bigger ones to do this in places like activism defense. But if you look at the big spend, places like JP Morgan, Citigroup, Deutsche Bank, places with massive payments businesses moving dollars in full scale and by the trillions across the world daily, they're the ones with the biggest spend on AI. If you also look at it, it's also consumer businesses, places like BNP in some areas, as well as Wells Fargo, that are spending a lot of money on AI when it comes to things like chatbots, or Morgan Stanley and JP Morgan when you think about their wealth businesses and investing businesses and how clients can be really using generative AI to do different things than maybe they had traditionally done, potentially at scale and at a lower cost. So when do these investments start to pay off and these banks start to show the return on those investments will be another interesting thing to kind of give to investors. It's a little easier, Tom, now, isn't it? Because so many investors around the world are really looking at many companies to show their AI strategy. And so that tech spend from JP Morgan, just beyond the competitive threat and to play a little bit of offense here, is very interesting.
Shonali, what is your sense of how deeply leaders, executives are thinking about some of the AI risks? Technologies, of course, like these can improve efficiencies and profit and margins. But you just think back to the flash crash of 2010 as a reminder that tech can trip you up as well.
Yeah, absolutely. They're thinking about not just AI risks, but remember, people don't talk about it nearly enough, the cyber risk that's under the surface here, and who they're working with, both in terms of an IP protection perspective as well as a cyber risk perspective. So there's a lot of things to think about there. You think about how their clients are using AI. AI as well. And you see how many limitations there are, Tom. This idea here that, sometimes the data inputs can be wrong, or even the market is too unpredictable to rely on AI completely. So I guess that is a positive picture for the job story, but to the point that you're making, there are risks, and the bankers are thinking about them all the time.
Certainly something that we're going to be keeping an eye on as we kind of see that marriage between tech and banking. Shonali Bassick, our global Wall Street correspondent, we thank you as always. Coming up on the program, retail earnings continue. Macy's due to report its first quarter results ahead of the U.S. market open. We're going to get a preview of what to expect next. Stick with us. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. A look at what's ahead today then. The ECB's account of the May meeting coming out at 7:30 a.m. Eastern time after we got that softer than expected inflation print. Then we get initial jobless claims in the US. That's at 8:30 a.m. Of course, after that shocker, the JOLTS number coming in much higher than expected, followed by US manufacturing data. And finally, Fed speak continuing with Philly Fed President Harker. That's at 1 p.m. Kriti.
And of course, we're also going to be watching the micro front on the docket today. Macy's earnings coming up shortly. The company reports its results ahead of the opening bell, and it could show a slight drop in consumer spending as shoppers start to cut back. Bloomberg's Madison Mills joins us now. Walk us through what we can expect here when it comes to one of the biggest consumer names in America.
Yeah, like you mentioned, Creedy, this could be the latest name added to the list of retailers showing us that consumer spending is finally starting to weaken a little bit because of those macro headwinds. We are expecting, in the average analyst estimate, is a revenue decline of 5.5% in the latest quarter. Macy's hit a 52-week low yesterday, falling 39% since the end of the fourth quarter last year. Now, Bloomberg's second measure tracks retail data through transactions at these big retailers, and that also indicates that Macy's is having potentially a little bit of a slowdown, falling below the overall consensus, similar to what we saw at a Foot Locker, at a Target. But to get to some of the good news here, we did see other mass retailers like the owner of Michael Kors doing pretty well in their earnings, so that could be a boon for a Macy's. We're also seeing that they have really effective inventory management, and that could be good news for them. Some analysts are quoting that as a positive in their notes about Macy's in the last couple of days. So those are going to be the key things to watch heading into earnings at 8 a.m. today.
And Madison, as you round out the earnings that we've had through from some of these big retailers, what does it tell us about the strength of that sector in the US and, importantly, of course, the strength of the consumer?
Yeah, one of my sources put it really well. She said that you have to look so granular this earnings season. It's not just about the individual companies, it's also about the individual consumer. And looking ahead, it seems like consumer packaged goods companies and those consumer staples are going to be the ones that will perform well. We're looking at Procter & Gamble, Walmart, Pepsi, Coca-Cola. These are the firms that when I speak with analysts, they say they are looking ahead to a good rest of the year for them, particularly as we even head into 2024 and see some dollar weakness as well.
So we've talked about the macro headwinds. Let's talk about the tailwinds here. What does they have going for them right now?
Yeah, so as you know very well, Creedy, these freight costs coming down are potentially a huge plus side for these retailers. And that's something that particularly stands out for a company like Macy's that, again, has been able to control their inventory and make sure that they're managing that well. Macy's is known for having really good data analytics that helps them to really accurately suss out exactly what consumers are going to be purchasing. Another tailwind is luxury. We saw that Ralph Lauren had really good earnings because their consumer is able to stomach a little bit of a price hike. They rose prices by 12% over the past year, and that was able to get them through this tough earnings season despite some of those macro headwinds because their consumer is able to stomach those costs. So we could see Macy's brand like a Bloomingdale's and Bluemercury really allowing them to maintain their strength this earnings season.
Something we'll be keeping an eye on, of course, Bloomberg's Madison Mills all over that story. Thank you for waking up early for us. We always appreciate it. Let's look at some of the stocks we're watching in the pre-market. Of course, Macy's going to be top of mind. The earnings expected to usually come around at 8 a.m. New York time. You are seeing those shares higher. Some optimism, as Maddie just pointed out, baked into those markets, higher by about 4.3%. And it's going to be a really important consumer story, just given that they do have that extreme exposure to the luxury sector as well. But of course, we're going to keep an eye on tech as well. Remember, NVIDIA retreating from that $1 trillion mark, but potentially marching back in that direction, higher by 1.4% this morning. What's interesting is that Intel is also catching a little bit of a bid. The CFO coming after the bell last night and saying their second quarter sales are near the upper end of their range. NVIDIA also saying they may be partnering with Intel when it comes to some of their chip technology. On the other hand, C3 AI came out this after the bell yesterday as well, dropping by 20%. Growth concerns there when it comes to the AI story, Tom. So already seeing a little bit of nuance with how this market interprets that story. And of course, let's talk about the big heavyweight when it comes to the S&P 500 and the Dow. Salesforce falling this morning to the tune of 5.5%. We're seeing those shares trade at about $211.20. Those growth concerns really taking a hit. And remember, Salesforce is extremely exposed to the business investment story, Tom. So it's a little scary to start to see a lot of the corporates pull back on that kind of spending.
Yeah, the focus on profit versus growth for Salesforce, a concern for some. Here in Europe, a snapback in terms of sentiment after 3 days of losses. You're seeing gains of 0.7%. Every single sector now, bar one, is in the green, led by media, autos and banks. Some of that data out of Europe looking a little bit more positive, and the China read across as well. That is it for the early edition. Surveillance is ahead with Bill Dudley, of course, former president of the New York Fed, among others. This is Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Demand is starting to slow. We're seeing that way back in the supply chain.
The real question is, are investors pricing in growth opportunities over the next 5 years?
This has been a very slow-moving economy and market. If you have super high conviction right now, you're not paying attention.
What we've seen so far seems more consistent with a soft landing in the labor market.
We still think we're going to be in recession by the end of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Welcome to Wall Street, where a month feels like a year. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. As we close out May and kick off June, your equity market just about positive by 0.2%. Shout out to Jim Reed at Deutsche Bank this morning. Really enjoyed that note. TK reminding us that First Republic was taken out by JP Morgan in May. I'd totally forgotten that.
Yes.
That felt like months and months and months ago, TK.
We had a couple comments yesterday that it's not over. I mean, I thought Bob Michael yesterday of JP Morgan was just riveting in his view on this, and that the deposit dynamics are still there, and that's a huge story for June and frankly into the summer. We've got to remind ourselves, June 1, and it's simple. There's a wall of economic data today. John, you love the ISMs, and we've got an early jobs Friday tomorrow.
Yesterday, whipsawed three different ways. We had the Chicago PMI, ugly, okay, deal with that. JOLTS data, job openings, surging, had to deal with that. And then Fed speakers came out. Whatever you do, don't call it a pause. It upsets them. It's a skip, Brammer. It's a skip.
Okay, so this sort of whipsawing action, I couldn't get my head around. The JOLTS today, I thought, okay, well, this shows a hot labor market. The ISM, okay, yeah, we've got a manufacturing recession that's not great. And then Fed officials come out, and what does data dependency mean? And I know that you've been on this all year long, but basically the data doesn't matter. If we get a really hot jobs report tomorrow, do we really get a difference, or are they going to do a pause, skip, whatever you want to call it, this month?
What did Governor Jefferson say yesterday? Something like, if we do pause, we mean skip. And that skip would mean that we could hike again. But it doesn't necessarily mean that it's a peak rate of the Federal Reserve. Do you think the market's going to see it that way?
It's what the market is actually saying this morning. Right now, what you are seeing baked into the Fed futures markets are basically there's going to be no hike this month, and then there's going to be a 25 basis point hike in July, and then it will be cuts later in the year.
Barclays say hike in June still. Data's going to push them over the line. Citi, Andrew Hollenhorst talked a lot about Andrew. He thinks hike again in 2 weeks, and then hike again in July, Tom?
I'm way more interested in China. I thought yesterday's China dynamic was far more important.
Well, thanks
than
for listening
Fed
to us,
speak.
but carry on, please.
I don't agree with any of this Fed parlor stuff.
Oh, okay.
I think it's just
Great.
a
Value
modern
add.
invention of the futures market, and the answer is skip, pause. What's Beijing going to do? Are they going to skip or pause here with an imploding economy? Zero Hedge featured Bloomberg's George Lee of our markets team in their summary of all the research and guesstimates on China. Guess what? Jobs report Friday. China opens Sunday evening, New York time.
They can't reopen twice, can they? That's the problem. Where's the growth engine going to come from?
Yeah.
Where's the challenge to the dollar strength we've seen over the last few weeks going to come from?
And then what does that mean for Europe? I mean, honestly, these are all of the stories that have been hard to get a handle on. And I've got to say, going back to where you began, this idea that a month feels like a year. Think of all of the narratives that we've gone through each week. And here we are halfway through at an inflection point, maybe, with the Fed showing that clearly the risks right now are to the downside, and they're aware of that. So again, we have to wonder, what are they looking for to give them a sense that they should be hiking rates?
The last 3 minutes felt like a year. Let's get to the price action. Equity futures on the S&P 500 positive by 0.2%. China in the bond market yields higher by 3 basis points, 367.52. Why do you never listen to us, TK?
I don't believe. I think the media parlor game and all the Fed speak. It's not that it's a waste of time. It's just complete slave to the data. The most important data, I guess, is the wall of data today. ADP doesn't matter. I don't think so. Claims, and then of course tomorrow's data onto the inflation data is far more important.
Is that why you stopped reading the Fed speeches?
Some and several of us have stopped reading it.
You can tell. Bramo?
Okay, we're talking about the data dump. Let's just give a sense of what we are expecting. Jobless claims at 8:30 a.m. Very interesting to see whether they do continue to tick up, especially after the JOLTS data yesterday. ISM manufacturing PMIs at 10 a.m. I'm very curious to see whether that reflects the Dallas Fed data yesterday. We also are hearing from Philly Fed President Patrick Harker, which will be interesting to see at 1 p.m. whether he sort of double downs on the skip, pause, whatever you want to call it, this month. Today, we have banking executives speaking at the Bernstein Annual Strategic Decisions Conference. This will be interesting, especially in light of the acquisition that we've all forgotten about, First Republic. We hear from John Waldron of Goldman Sachs, Bill Demchak of PNC, which actually might be the most interesting to me, simply because of the regional banking issues, and Brian Moynihan of Bank of America. And today, retail earnings before the bell, Macy's, Land's End, Dollar General. Very curious to see particularly the lower end, and Lululemon after the market. I like Lululemon.
I know. There's nothing wrong with that.
I know.
I can make it sound like it's a secret that you can't talk about.
I mean, I don't know. Like, I'm just explaining that I like the casual trend, and I know it's on its way out, and I am curious to see whether that's reflected in the earnings.
Is it on its way out?
I don't know. I mean, that's what I hear from different people.
Man, trying to push it out of Midtown.
I know. You've been on a single-handed crusade to get rid of it.
Sell in May and go away. SPX flat.
You really aren't
Dow,
listening to us, are you?
-4. NASDAQ, as you mentioned yesterday.
Up 8%.
Up 8%. 500 basis point up over equally weighted NASDAQ.
Any comments
I have
on
never
Lulu?
Seen that. No comments on
Okay. Ross Kostrick
I've never
joins us
been
now.
in a Lulu.
BlackRock Global Allocation Fund Portfolio Manager.
Maybe I should.
Russ, the scores are in. Tom mentioned them. The S&P 500, marginal gains for the month of May. The NASDAQ still absolutely flying. You've been very clear every time we've caught up, consistently adding equity risk. Now, Russ, can you tell us where you've been adding that risk?
Absolutely. Good morning. So, Jonathan, I think as you might remember, we were underweight in the fund for really most of 22. Thankfully, that proved to be the right thing. We've been adding back, and the thesis is fairly simple. The economy has proven remarkably resilient. We've spoken about the reasons: the labor market, excess consumer spending. And the reality is, as we saw as we had the Q1 earnings results, corporate America is actually doing all right. And in an environment in which nominal GDP is likely to hold up a lot better than many of us thought 6 months ago, we think there's still an opportunity to add back on weakness. What we've been focusing on is what I'd call stable growth, high quality growth. In other words, we're not looking at the unprofitable companies that were ripping in late 2020. We're looking at companies that can generate earnings consistency, margin consistency, low leverage, that are very profitable. Right. And that's where we've really been focusing the ad so far this year.
Are there a lot of those companies out there? I mean, I know you got a fancy computer screen. Maybe you're doing it off your iPhone. But, Russell, there are a lot of companies out there that give you that quality free cash flow growth.
There are actually. Clearly the market's been focused on one thing for the last few months, and that's been tech. And parts of tech that are most levered to AI. And there are a lot of themes there that actually we like long term, but there are other parts of the market. It's not simply tech that evidence these characteristics. You can talk about defense companies, luxury good manufacturers, parts of industrial. So we are finding that there are a lot of companies, many of them US based, that are giving you that quality cash flow that's likely to hold up, even if we do see some slowing in the back half of the year, which is, let's be honest, the most likely scenario.
My favorite part about your note, Russ, is that it sounds risk on, right? This idea we've been consistently adding to equity risk. Okay, so you're bullish, you see opportunity, and then you go on to read the rest of it. The economy is decelerating. We expect there to be an increase in defaults. We're going to have issues. Perhaps recession's not a foregone conclusion. But at this point, is there sort of an interesting conclusion here that in some ways equity risk in some of these companies with all of the caveats is a safer bet than certain slices of the bond market?
I think that's a really good way of putting it. And just to be clear, we've been adding equity risk back, but we were adding it from a very underweight position last year. So it's not a back up the truck moment, but it is a moment to have that exposure. And I think the point you made is a very good one. You think about what is done well in this environment where you've had a mini banking crisis. You've had concerns about the debt ceiling. The companies that people have faith in that are going to produce solid earnings regardless of those outcomes. And again, if you have a drawdown in the market, you're going to see these names take a hit. But long term, 6, 12, 18 months out, I think these are places not so much to hide, but to weather what is likely to be a slowdown and what is still likely to be, an environment where there's some uncertainty around how far the Fed is going to go.
And we were talking about this yesterday about whether bonds will still provide the offset, or actually in some ways, if some of these cash flow stocks are kind of the new offset at a moment where 60-40 doesn't necessarily have the same automatic dependency.
Yeah. Well, 64, I don't think 60-40 is quite as dead as everyone made out to be last year. And there have been periods this year where that bond worked very well as a hedge. In the aftermath of SVB, that stock bond correlation, after being very positive in 2022, flipped back to negative. Having said that, I do agree that it's going to be a little bit more varied. In other words, if we get the bad inflation print, if the Fed is going to talk about going further, you're going to see that stock bond correlation flip more than it did for most of the last 10 years. So it's really a matter of both. Having some good high quality carry in the portfolio and having these companies that evidence quality. All the debate about growth and value, this is the attribute we think is most important in a portfolio right now.
Russ, you just seem like you're in the zone right now and things are going right. I'm just reading this note. We have also added a small gold position as a tail hedge. Even your hedges are working with equities flying. What's the gold position about, Russ?
The gold position is always a tough one. And, we've had gold back in 2020. We took it out last year when the dollar and real rates are ripping. The gold does a couple of things. One, in an environment, if we start seeing the back half of the year, real rates are declining, gold responds well. The dollar looks to have peaked. That's another tailwind for gold. But the other factor, which we've been living with for much of the last 6 months, whether we're talking about the uncertainty over China, the ongoing conflict in the Ukraine, and the debt ceiling, one thing gold tends to work well as is a tail hedge when people are really worried about the wheels coming off.
Interesting. Russ, thank you. Russ Kostruck there of BlackRock. Gold up nicely year to date by 7 or 8%, TK. You've been looking at that, I know.
Oh, I always look at it. Dennis Gartman gave us a briefing yesterday. Obviously, he is in gold. He's always in gold. But what's fascinating off the Gartman call is gold in euros. Gold in yen. It's an extraordinary performance against yen. It's on edge of moonshot.
We haven't talked about the debt ceiling debate yet, have we? 314 to 117 through the House with ease. Speaker McCarthy calling it a bit of a win. You'd expect that. One key caveat, I think, to that win. More Democrats voted for this than Republicans. Ramo.
This is going to be a hard sell in the political theater sphere, which we're going to be hearing a lot of.
Next step to push this one through the Senate and get it to the president's desk. Coming up next, Heidi Kribo-Rediker of the Council on Foreign Relations from New York City as we kick off the month of June. Welcome to the program. Equity futures positive by 0.2%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Iran has reinstalled monitoring equipment and boosted its cooperation with international inspectors, even as its engineers added stock to stockpiles of uranium. The findings by the IAEA in its quarterly report reduces the likelihood Iran will face censure when diplomats discuss its nuclear program next week. Around 50 Credit Suisse bankers are suing Switzerland's financial regulator for rendering their bonuses worthless. A Swiss federal court spokesman says they're suing over the write-down of so-called contingent capital awards. The bonuses were based on AT1 bonds, which were wiped out in the emergency rescue of Credit Suisse. NVIDIA's CEO is said to be heading to China later this month to meet with tech executives in the world's biggest chip market. A source says companies on his itinerary include gaming leader Tencent and TikTok owner ByteDance. The CEO's first China trip in years will come as the U.S. tries to curb Beijing's access to leading-edge chip technology. The U.S. House has passed the debt limit deal struck by Speaker Kevin McCarthy and President Joe Biden to avert a catastrophic U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday night.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the President's desk as soon as possible.
The compromise deal drew opposition from the flanks of both parties. Objections from conservatives could force days of debate in the upper house. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
City.
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jay Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, Friday on Bloomberg Television and Radio.
Tonight, we all made history. Because this is the biggest cut and savings this Congress has ever voted for.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the President's desk as soon as possible.
House Speaker Kevin McCarthy, Senate Majority Leader Chuck Schumer passing a deal with ease through the House. Lawmakers from both parties voting for that debt limit deal at 314 to 117. As Senator Schumer pointed out, it's on to the Senate from here, potentially a vote on that Friday into the weekend, and then onto the president's desk. And Tom, hopefully we can all move on.
I don't think it's that easy. I think the Senate, Greg Villiers features it this morning. He thinks the Senate's going to be sport because of two senators, and we can go into that as they slow it down and block it up. Margot Sanger-Katz with a brilliant article that both Lisa and I saw in the New York Times, and I love this phrase, John. It's Thursday. It's not Claims Thursday. It's agreed upon adjustments Thursday.
Do you want to explain that?
Beautiful chart. Here's where we are now. Boy, are we saving a lot of money. Let's pull that puppy back over 24 months. And the answer is, Lisa, to me, you know, the Sanger-Katz Parlapiano research in the New York Times, which I'm sure CBO will catch up on, is we're doing nothing here. We're spinning wheels.
Well, but that's exactly my conclusion. Basically, let's agree to disagree on exactly how to deal with the big problems and basically come up with window dressing to put on top so we don't actually have to
Because 2 years out, we're going to readjust it with sidecar deals, John. I mean, it's almost like the British government.
Not quite. At least they agree on a budget and push it through. This is the new world, isn't it? And it's been going on for a long, long time. You manufacture a crisis and you negotiate the budget. We're going to see this act again and again and again.
Bring the banner up again on radio. I'm sorry. It's just too good to be true. Thank you, Margot, for this. It's agreed upon adjustments Thursday. They agreed upon adjustments down the road. And that's it. I mean, there's nothing really else to say. We're going to go on right now from the budget, try to move away from that. Heidi Krebo-Redeker is with a senior fellow, Council on Foreign Relations, really writing as much as she can on what we were talking about yesterday and continue today with Rika Renminbi, and that is China. Heidi, thank you so much for joining. Is the China slowdown for real?
So I think, you have a lag in data and some revisions, and I don't know if we really understand if the data coming out of China is accurate, in part because they're coming out of a very, significant COVID lockdown. So just think back to when we were publishing our data and revising.
A lot of the doubt about China will be solved by electric vehicles and their growth. Discuss that export might we're not factoring in.
So I just got back from Europe, and China was a key part of all the conversations because of the U.S. EU Trade and Technology Council. And we had Secretaries Blinken and Raimondo there, USTR, Tai. We saw kind of a focus just on the main bone of contention, which is that the subsidies for EVs in the U.S. are not offered to EU automakers because of the China components to the vehicles. But I think that you have this muscle memory of trade negotiators of going after what's happening between the U.S. and the EU, and at the same time you have China exporting more electric vehicles, more autos that are Chinese autos. Right. Just a striking uptick in particularly EVs.
Lisa, there's the analysis, and the further analysis is whoever's out on Twitter trying to figure out when Mr. Musk's airplane leaves Shanghai.
Well, yeah,
that's happened in the last 24 hours.
Exactly. I know that we want to move on from the debt ceiling, but I kind of can't yet, and I have to sort of pair it into the conversation that I'm sure, Heidi, you are having over in Europe, which is what are these subsidies going to look like, particularly when it comes to the recent tech-driven investments that the U.S. were promising to make. Did anything really change? Was any of the heft of some of those programs removed from this agreement that we got from the debt ceiling, or was it basically the adjustments that kind of came in after the fact and made sure it was all okay?
So, one of the great things about being overseas is that you really didn't have a lot of focus on the debt ceiling, as opposed to like living at 24/7 here. The focus on U.S. politics was much more driven by Trump and looking at the numbers and the upcoming election and whatever deals are being struck right now between the U.S. and the EU, are they up for grabs if Trump were to win the presidency in the next go around? So I think, that's Trump played a prominent role and concerns in whether or not there was a need for Europe to hedge in its negotiations, not for all countries, but for some countries. I think that's why we didn't see consensus, the same kind of consensus that we saw at the G7 and the Quad meetings in the past 2 weeks, when we, with our negotiators in Europe this week.
What does that mean with respect to U.S.-European alliance, with respect to China, with respect to some of these bigger issues? If there is sort of a pretty tepid receival of the United States with sort of ambiguous leadership?
So I think that the U.S. seems to be very much in line, and the Biden administration's in line with the EU Commission. It's just that there are 27 different member countries, and all of them are sort of playing out how they want to, how they perceive weakness versus strength and need to hedge. And because you have to have unanimity, it was in full display, and particularly around China this week, that you just don't have it in the EU, where you do, I think, really in Asia to a larger extent, vis-a-vis China.
I'll be less diplomatic. You have the Commission, and then you have Macron. And that's why things are confusing in Europe right now. And Lisa, that's been the story, hasn't it, for the last couple of months?
Well, yes. And Emmanuel Macron is like, hey, we're going to strike a deal with you. Go, China. Yeah, right. Let's go to Beijing and the rest of Europe. It's like, what are you doing? At the same time, I wonder how much reticence there is to really partner with the U.S. in light of some of the recent subsidies, in light of some of the potential volatility. You think this is just a Macron issue?
Oh, the reports I hear about how well-liked Macron is at the G7 is just kind of,
well-liked.
Or how
I was about to say.
Less liked, he's liked.
Right. I imagine that's the case.
That's me trying to be diplomatic. Heidi, thank you. Wonderful, as always, to hear from you. Heidi Krieber-Rediker there of the Council on Foreign Relations. Here's one for you. The relations around this. There's an OPEC Plus meeting into the weekend. This is from the FT, from Bloomberg, from a whole host of media organisations. Reuters, Bloomberg, Dow Jones banned from attending these meetings. That's got everybody's attention going into this.
Reportedly, there are some potential news outlets that have been invited, like the New York Times and CNBC, but it's unclear whether they will go. That is what I'm hearing anecdotally. The bigger question is, what are they doing? This is the first meeting where they're meeting in person. There are likely going to be output cuts that are going to be implemented in order to get the price up. What are they trying to basically message here?
Just before we went to air, Edward Morse published at Citigroup.
What did he say?
And the summary of it is simple. OPEC Plus and its, quote, market power. It was an exceptionally diffuse note by someone who is nailed the price of a barrel of crude. Ed Morse, more than anyone I know, has gotten this call right. And he says they're struggling with what is their market power. And I wonder if that's where this blockage of news organizations comes from, is they're petrified about how to get their message coherent, how to get their message out without the journalism that goes into questioning policy and the rest.
Well, to be fair, also, OPEC Plus and the countries that make up that cartel, not exactly known, many of them for their free and open press in their own countries.
Yeah. Well, and it's not like the media outlets aren't going to go and aren't going to speak to people who are in the room. So again, what are they playing at? Why is this? What's the signal here?
You can see it, can't you? Some of the media organisations on the outside just kind of texting the delegates on the inside.
You know the phrase here is
getting the stories. Oh yeah, sure.
I mean, come on.
The key phrase here is simple. It's Javier Blas's fault.
Javier Blas is coming up in about 20 minutes. Looking forward to catching up with Javier. Crude right now, 68 on WTI, totally unchanged. To kick off the month of June, equities slightly positive. From New York, this is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Just about closed out May with a monthly gain on the S&P 500. A very marginal third month of gains on the S&P. Nothing marginal about it on the Nasdaq 100, up by almost 8% to close out the month. On the session right now, just about positive by 0.1%. You can thank the likes of Nvidia for that. Nvidia through May added almost $250 billion to the market cap of that company, Tom. How impressive is that? $250 billion US dollars.
I'm going to suggest we've never seen it, but I think a lot of other things lifted up as well. What's interesting is 1 year trailing, sell in May the last time around, NASDAQ up 7%, SPX flat essentially, and the Dow flat, a little bit negative as well. So it's been a 1 year churn here around all the emotion we're covering every day.
Yields were up through last month. They look like this right now. 2-year, 10-year, 30-year, higher again to kick off June by 4 basis points. Trim that monthly advance in yesterday's session. Right now, 444.64. So on the month, up something like 40 basis points on a 2-year as we started to price out cuts. I think pricing out cuts is the right way to put this as opposed to pricing in hikes. Pricing out those cuts, though, happen to drive some dollar strength with some real weakness in the data in China, in Europe. In the single market, looking at the single currency, the euro against the dollar shaping up as follows. Euro dollar 107.09, just reclaiming that 107 handle in the last hour or so. But on that currency pair, down about 3% on that currency pair through last month in May. That's the worst month this year. In fact, it's the worst month going all the way back to April of last year, Tom.
Can we all agree it's a surprise of the year? I think everybody was looking weak dollar.
There's been many.
There's been many, but
doubts about tech ripped.
Yeah.
Doubts about the Fed. They may hike again. That's about the dollar. Dollar's stronger, Lisa.
Surprise of the week, which is basically a year when it comes to 2023.
I take your pick. I remember when everyone lined up saying, buy the banks. Do you remember that?
Oh, yeah, that was good. That was good. January, February.
Banks didn't work out either. Had a lot of Fed speak recently. President Harker on tap ahead of the quiet period. Fed Governor Philip Jefferson signalling a pause may be in store with more hikes to follow. A decision to hold our policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. Skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. He's sounding more and more like a Fed vice chair, getting the committee together. Look, there is consensus on the committee right now. It's on two things. One, no cuts. And two, if we do skip June, we're not calling it a pause. So you can just see how the language is shifting. And if you wanted to find consensus on the committee, if that decision was today, you can see where Chairman Powell would find that consensus.
But the answer is what they're all on the same page on is they're all looking at the data. I mean, they are slaves to the data right now. And the labor is we had Randy Krasner on from a couple of weeks ago, and the answer is unemployment, jobs hasn't broken.
Elisa made this point earlier, though, Tom, and I think it's a really important one. Some people might interpret the comments of yesterday as de-emphasizing the data that comes out tomorrow.
Yeah, fair.
De-emphasizing CPI.
When's
and really emphasizing that we can skip June, wait and look at what the data that comes together ahead of July.
Can we get existential?
If you want to, sure.
What if the Fed does in a quiet period and they get in the quiet car in the Excella? What happens? It's like Stephen Wright, the comedian.
1-800 Wall Street Journal and plant a story again. Say we're hiking because CPI was too hot.
They can't. They do it by text because it's the quiet
What
car.
do they call that? Nicky Leaks.
Yeah.
Over at Wall Street.
That was a Stephen Wright moment there. Quiet people on the quiet car. Let us move forward now, and it is our immense pleasure to speak with Alan Ruskin, Chief International Strategist at Deutsche Bank. His notes are absolutely fabulous. You can get them, of course, through Deutsche Bank. Alan Ruskin, you have an absolutely brilliant paragraph on M2 dynamics and nominal GDP. Is the surprise of the next 12 months forward that we have sustained nominal GDP because of sticky inflation?
It's a little bit like that, Tom. I think we're, going to see, for example, data today which shows that productivity was extremely weak in Q1, but not just Q1, on a trend basis, it seems. And that weakness in productivity translates to high unit labor costs, which is sort of stagflationary. And output, we know, is relatively weak relative to employment. That's part of the weak productivity story. So it all adds up to nominal GDP doing an awful lot better than real GDP at this point. Some of this, I think, is just this natural overhang from the M2 growth. We had, something like 30% M2 growth above trend a year ago. That's down to about 20% overhang, thanks to weaker M2 growth that we've seen more recently. But still, I think that's really propping up the nominal numbers. But monetary policy and money supply is a veil. It doesn't ultimately pay you to print money. It doesn't generate real GDP growth.
The real GDP growth is the recession game. Your colleagues have been brilliant on this. Matt Luzetti has arguably the single best recession delay call of the last 18 months. Reframe that now. I'm not saying agree with young Luzetti, but at least frame out the Ruskin recession to come.
Yeah, I've always been of opinion that given the overshoot on inflation, even if we have a mild recession, I would still cast that as potentially a soft landing sort of scenario. I know that's semantics in a sense, but I think we're still pretty much on track. But we do need to see some weakening in the labor market. And of course, everything we saw from the openings data yesterday suggests that employment will remain relatively resilient. So you've got this weird dynamic again, whereby employment is relatively strong compared to output. And particularly, I think we're seeing weakness in the manufacturing sector worldwide. So there's another story there as well. But I would say that we're still on track for something which skirts recession/shallow recession, but it's not looking like a deep recession unless we get some sort of nonlinear event like the banking sector crisis sort of really taking hold and a proper credit crunch, which we have not actually seen as yet.
You mentioned manufacturing, Alan. That distinction, I think, is so important. Manufacturing PMIs worldwide, Europe, China, south of 50, contractionary, throw in the United States, pretty ugly there. It screams rate cuts in some places. Then you look at services, Alan, which make up the bulk of some of these economies, still pretty robust. Alan, the surprise of the last month or so has just been the breakdown in another consensus trade. Dollar weakness to dollar strength. Alan, as you look at things right now, have we broken that trend? Is this something new? And if it isn't, where does that new engine of dollar weakness come from?
I think it's deferred dollar weakness. The whole idea of a divergence trade that worked against the dollar, whereby Europe, if not outperforming, at least the ECB was hiking whilst the Fed was on hold, and China was obviously sort of reopening and strength that we would expect there, or what we did expect there. A lot of that just hasn't materialized. In fact, if anything, the US has been more resilient than anticipated, and consequently, I think what you're seeing on the exchange rate is very much reflective of what you've seen on interest rate spreads. So the interest rate spread story is just taking its cue from this relative growth story. I think right now, it depends on where the Fed goes. For example, if they hike in June, It seems less likely after yesterday's Fed comments, but if they hiked in June, I think we'd be down at 105 on euro dollar. If they don't hike in June, we can trade here in the sort of 107 sort of area for the time being as far as euro dollar is concerned.
Alan, you had this really interesting point in your latest note where you basically were saying there's a little risk of over-tightening. That does not seem to be the theme that we're hearing in the Fed speak that's been coming out every day, day after day. Can you explain that, what that means as to where policy should be, where it will likely be, and what that means for longer-term inflation?
Yeah, I mean, I think just look at your financial, conditions indicators. We all have our own numbers, but if you look at the Bloomberg numbers, for example, you look at, say, 6-month financial conditions, 12-month financial conditions. If anything, they've eased rather than tightened, which is truly extraordinary. So the tightening needs to come from something like the credit side. You're not seeing it in terms of credit prices, particularly. Maybe, issuance markets are tight and closing up. But in general, you're not seeing this kind of non-linear event that I think would have tightened financial conditions sufficiently to really risk over-tightening. Now, maybe the Federal Reserve, which has, some distinct advantages in this sphere, and knows a little bit more on the banking sector side. It's clear that you do need additional consolidation over the longer term. But I think that holds the key as to whether financial conditions tighten materially. It looked like they were tightening sharply, a couple of months ago, and now much less so.
Alan, wonderful to get your view. As always, Alan Ruskin there of Deutsche Bank. Thank you, sir. We always talk about moving fast and breaking things. The Fed has moved really, really quickly, and some things have broken. Let's be clear about that. But this economy is moving much more slowly than people anticipated. If you think about Chairman Powell, and we often reflect on that speech in Jackson Hole, what was it, 8 minutes? 8 minutes, Chairman Powell, we're going to do more, we're going to do more. The end of August, we need to cause some pain. If we don't cause pain, it will mean even more pain down the road. Unemployment's at 3.4% going into payrolls tomorrow. And take the last month for that matter. When we started May, we were just coming off the banking turmoil for the regional lenders, and we were all anticipating this aggressive tightening in financial conditions and lending standards, and that's what Alan's alluding to there. Lisa, it's all just happening much, much more slowly than people anticipated.
And the pressure to buy is still there under the surface. And I thought that Michelle Bowman really reflected that well yesterday, the Fed governor, when she came out and said what you can see is that any kind of loosening whatsoever in financial conditions, any kind of decline in mortgage rates, re-up the surge into housing. Immediate prices go up. So basically they can't kill it with rates that are much higher, that are more than double where they were before on an average. This to them indicates perhaps there is this excess that really hasn't been beaten out of the system yet.
But this is why they're so nervous about the next decision. You get lulled into hiking too much, don't you? And I think the balance of risk has clearly shifted for them too. We close out 2022, the risk of doing too little outweighs the risk of doing too much. What about now? Ask them that question now. Where do they stand on that now?
They want more time to see. The data's been confusing. The data's been all over the place as we talk about the whipsawing of yesterday's information that came out. How much can they really have conviction at a time when there still are the lag effects? And I do have sympathy for that, but at the same time, it's unclear whether the risks of a reigniting inflation are really off the table.
Sympathy for the Fed. Where's Bramo? Where's the real Bramo?
It's not. Hold on a second. It's not sympathy.
Like 6 days off.
Around the table.
Yeah,
I'm not. It's not sympathy for the Fed. It's sympathy for the plight of trying to understand a moment that is highly complicated.
Okay. Came into the studio this morning. Always the last one in. Bramo's late. Often happens.
Well, her entourage.
Comes in with the entourage.
And happy.
So, like bouncing off the walls.
And then yelled at for being happy.
Bouncing off the walls.
How can you?
Well, it just didn't have any authenticity.
Oh, come on. I was super happy. Trust me.
I think the audience at home would agree with me.
I'm thinking of buying a puppy.
It didn't really.
There you go.
Really?
Go get two. No, dive in. Get two. Get two.
7:30. Let's see if Deborah Cunningham of Federated has any sympathy for the Federal Reserve.
Oh, come on.
That conversation in about 50 minutes. Have you become friends with the chairman? Is that what this is about?
Honestly, I'm sympathetic to the plight.
Interesting.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Ukraine's capital was hit by missiles overnight. Kyiv's mayor says at least 3 people were killed, including 2 children, by debris. NATO foreign ministers will discuss Ukraine's bid to join the military alliance at a 2-day meeting in Oslo today. Meanwhile, Ukrainian President Volodymyr Zelensky made an unexpected appearance at a summit in neighboring Moldova. And the summit is taking place less than a dozen miles away from the breakaway region of Transnistria. which hosts Russian troops on Moldova's eastern border in Ukraine. Zelensky says he will hold bilateral meetings at the European Political Community Summit, where he will propose setting up a coalition of patriots. Former European Central Bank President Jean-Claude Trichet says despite an environment of great pessimism, Europe's boldest endeavor was the creation of the bank. He spoke to Bloomberg on the ECB's 25th anniversary.
Also proved something which is very important, I would say, historical trend. We started with 11 countries, we are now 20 countries. In my 8 years of mandate, I welcomed 5 new countries, you see. So there is something underlying, which is very strong.
Meanwhile, Vice President Luis de Guindos says that the ECB is in the final stretch of hiking interest rates, with further decisions to be data-driven. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg. Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think the speculators, like anything in any market, they are there to stay. I keep advising them that they will be ouching. They did ouch in April, but but I would just tell them, watch out.
Prince Abdulaziz bin Salman, the Saudi energy minister, last week at the Qatar Economic Forum, speaking with Francine Lacqua. Great conversation. It's always the short side they're unhappy about. You know, it's that whenever we talk about speculation
oil's
at the
going to
government
100.
level, it's always the shorts.
Yeah.
It's like those speculators. Nothing speculating about being long, but being short, that's problematic.
Okay, well, if it is speculators, then how are they going to justify the rate cuts, the production cuts that they're going to implement if there's no fundamental basis to where we are? I'm just saying.
They want to flush them out. If you look at the fundamentals, and Grant Smith did a great job on Bloomberg today, just kind of breaking this down. On the one hand, inventories are shrinking. On the other hand, you've got weaker data out of China. Just trying to put it together right now about what the right policy would be, Tom. I think it's not so straightforward.
Correlated in a Bloomberg commodity index, I should say. It's certainly been a weakness for commodities. This is a real joy. Javier Blas, the book is The World for Sale. He is definitive on hydrocarbons. This is the conversation of the day on OPEC+. We're thrilled that Mr. Blas could join us with Bloomberg Opinion. Javier, I'm going to cut to the chase, and I do not want you to speak for Bloomberg and other news organizations about the back and forth with OPEC+. I don't think that would be appropriate right now. But I do want you to speak about your essay the other day of the Aramco illusion that's out there, a brilliant piece on the illiquidity of Aramco. That speaks to an OPEC Plus that wants to play by its own rule book. What is the OPEC Plus rule book to get the price of oil higher?
Well, Tom, what OPEC has been trying to do is cut production, argue that they are cutting production because they believe that there are too much speculation into the market, that they are not targeting oil prices, that they are trying to increase investment into the oil industry for future oil demand. At the end of the day, the rule book of OPEC is to keep prices as high as they can. It used to be $50, it used to be $70, and clearly now OPEC is trying to keep oil prices the closest that they can to $100. That's the price that Saudi Arabia clearly is targeting. And it has not been able to do so, not so much for the demand, which doesn't look great for oil, but it doesn't look too bad. The main problem is there is a lot more oil coming from places like Russia than anyone was thinking 6 months ago.
Javier, I took Log Saudi Light yesterday, went back and did a careful study of the collapse of 1986, seared into the memory of all of OPEC and particularly Saudi Arabia. That gets us down to a barrel right now of $40, $42 a barrel. Are they worried about the ghost of 1986 or other times we've seen oil slide?
I think that is always present on the memory of any Saudi oil minister, including His Royal Highness Prince Abdulaziz. And they speak about avoiding the mistakes of 86. I don't think that we are facing any situation similar to that. There is not the amount of extra production coming from elsewhere in the world as it happened in 86. And also the demand growth for the next 2-3 years still looks relatively okay. It is a question of what is the price of oil that balance the market, and at the moment that's closer to 70 than it is to 100. And the other big problem to Saudi Arabia is that we have had quite a lot of accumulated inflation. We are looking at nominal prices for oil, but the purchasing power of the barrel is a lot lower today. What $70 today oil buys you in the international market when you are importing goods is a lot less than 5 years ago and 10 years ago. Those $70 start to feel very much like $50 a few years back.
We started the conversation talking about the gathering in Vienna, the in-person gathering of OPEC Plus, where certain news outlets are not invited. In a departure from the past, it seems like there is a bit of concern or disagreement with the message that's been getting out there. What does OPEC Plus not like in terms of messaging?
Well, I think that they don't like low prices. They would like higher prices. They don't like low prices. They don't like to see numbers of Russian production that they are much higher than they would like to see, and they would like to try to convince the market that everyone is cutting production as much as they are saying. News organizations like Bloomberg report things as we see it, and we have been not invited to attend the next meeting alongside reporters from Reuters and the Wall Street Journal. For me, I have been covering almost every OPEC meeting for the last 23 years. It is a first. But we will still continue covering OPEC.
And we'll probably be in Vienna having conversations with people who are in the room. I am curious, though, just going forward, if the concern is how the messaging is with respect to Russia and its production of oil, what's the meeting going to be like in terms of the tenseness between Russia and Saudi Arabia?
I think that everyone is going to try to put a brave face in Vienna this weekend. Agree that the production cuts are happening, and try to put a spin into the market that things are going to get tighter. And if you look at the forward balances for the second half of the year, it looks a lot better for OPEC. And even with the extra Russian oil, the extra Venezuelan oil, and more barrels coming here and there from Iran, things will be looking a bit better. The market looks as it's going to tighten into the second half of the year. So in some ways, it is surprising because it is not like panic situation. After all, Brent is trading close to the $75. I mean, my big surprise is that there's almost a sense of panic inside OPEC when the market is trading quite healthy, close to $75 a barrel.
But how much is this panic, Javier, that they're losing market share to Russia? That basically Russia is selling to China at a disproportionately high amount, stealing some of the business that OPEC Plus used to rely on, or OPEC without the plus. How much is that kind of the tension underplayed here that really has to do with China, where demand is, and why perhaps the demand there hasn't influenced pricing as much as people thought?
It's true that some OPEC nations are losing market share into the east of Suez, as we call the Asian market, to Russia. It's true that Russia is selling more oil into China and India that it used to. But it's also true that for OPEC countries, including Saudi Arabia, the European market is now their new home. Russia is not selling in Europe, so the Saudis are capturing market share there. So yes, while they are losing market share in Asia, they are winning market share in Europe. At the end of the day, it's a balancing act.
Yeah. Javier, you're world expert at all of the investment that goes into this. There's been a number of essays under your purview at Bloomberg Opinion on where price is and the motivation to invest in hydrocarbons. Is the price now shattered enough where we're going to see a dearth of investment in oil?
I think that the price have come down enough, around $70 WTI, around $72, $73 Brent, for some investment to be posed. We have seen a significant decline again in drilling rigs in the United States, and it's a combination of the price and also a new mentality in the industry that shareholder come first, that the industry needs to make enough returns so the shareholders are there, and we have seen that on shale, and certainly at some point we are going to miss that growth of the shale industry, and it may mean that the likes of the United Arab Emirates and Saudi Arabia can produce more oil going on in 2024, 2025, and onwards. But yeah, I think that prices have come down enough that investment into the industry is gonna start to suffer, at the very least at the margin.
Javier, you get to decide. Are we congratulating Sevilla or not?
Can I pass on that one?
I'll take a pass too. Javier, thank you. Javier Blas of Bloomberg Opinion, thank you very much. For any Sevilla fans, congratulations. Okay. Penalty shootout with Roma yesterday. Ugly penalty shootout.
Sincerity, really.
Ugly game. Just two teams that don't play. Let's say Sevilla doesn't play attractive football. It's kind of the dark arts of football. It's quite defensive. Throwing themselves on the floor a lot. Protesting to the referee.
Are you just asking for hate mail?
Lots and lots of that. I'm not sure how big the fan base of Sevilla is.
Okay, so you can.
I think I can take this risk.
I watched the other day for like 10 minutes. It's all I could take because of Sevilla against I can't remember who, because they're all falling down, just like you said.
Was it against Juventus? Might have been against Juve.
Can't remember.
That was a semi-final,
but everybody was falling down. Oh, yeah, I just can't. Americans.
Probably not, probably still in bed. Would have been drinking all night. Congratulations for those of you that did wake up.
Do you know that female soccer players don't do that?
Impressive.
Women's soccer,
You've got the data for that.
Actually, there is data somewhere,
That's
but
very cool.
They do fewer sorts of
simulations,
simulated kind of. Oh my goodness.
Interesting.
What do you think about the long minutes at the end of the game? It used to be adding 4 or 5,
it's
and
odd.
now it's 8 minutes.
Call it 10 sometimes.
Well, is that a big deal?
They need to work out how much time is wasting. The ball is not on the pitch enough. That's in the data. You can see that, and they're trying to work out how to address that problem.
Another nerd soccer question.
Sure.
When they set up for a corner kick, they never put the ball in the white line. They always cheat in an inch or two.
It has to be slightly over the white line.
Okay.
Yeah. So the edge of the ball might be over the white line.
They're like always cheating it.
Yeah, they're trying to work it out. Yeah. But there is a rule there, Tom, that makes sense.
We'll talk balls and strikes in the next
Let's not do that. Tracy McMillan of Wells Fargo joins us next. Welcome to June. Your equity market up.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities
are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Is starting to slow. We're seeing that way back in the supply chain.
The real question is, are investors pricing in growth opportunities over the next 5 years?
This has been a very slow-moving economy and market. If you have super high conviction right now, you're not paying attention.
What we've seen so far seems more consistent with a soft landing in the labor market.
We still think we're going to be in recession by the end of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Something for everyone in retail. You've got to work out, is this a story about Macy's or a story about the economy? Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures just off session highs, positive by 0.2%. But the outlook from Macy's, the department store here stateside, absolutely ugly, Tom. The stock performance, the price, down 12%.
Back to where it was, off the pandemic with a nice little bounce here. There's been some enthusiasm. We heard the wonderful Oliver Chen on this with Cowen recently. You know what, John? It's just as simple as this. You've got Macy's negative 8% per year over the last 10 years. This has been a mid-market train wreck over the long term.
Some of these headlines on a consumer, excess merchandise, markdown still to come, Bramo demand trends weakened in discretionary categories. Macro pressures on the consumer, they assume that that gets worse. Now, just looking at this pouring out, we were all talking about this in the commercial break as these headlines dropped. Lisa, it's very difficult to get a broad understanding as to what is going on with the retailer right now. Because if you look at Macy's, they're telling the consumer's not great. You look at another retailer, they'll tell you everything's okay.
We heard from Nordstrom's yesterday, and it was better than expected, so we saw those shares up. So basically, to your point, is this a Macy's problem or is this a broader issue? How much is this also just ordering the wrong types of stuff in still a pandemic economy? We've talked about whether it's people going back to work, going back to the office, now staying home, all of these different trends. The bottom line is this. They clearly are seeing something very significant in terms of weakening, even after all of some of the negativity priced in. There has to be this question of, is this particularly on the lower end of discretionary spending?
Just to bring you the headline from Macy's then, this is their full year outlook, a range on adjusted EPS to 270 to 320. They had seen previously 367 to 411. So that's a big drop away. That stock is down, as I say, by about 12% right now. We'll pick up on that story in just a moment. Here's the broader price action for you on the S&P. Just pulling back from session highs. Equity futures on the S&P 500 right now, positive by 0.2%. If you're looking at the bond market, Treasuries at the moment, yields higher, Lisa, by a couple of basis points 366.
Yeah, and we'll keep looking at all of the different retail earnings throughout the day. We also do get some economic data, jobless claims at 8:30 a.m., an ISM May manufacturing PMIs at 10 a.m. All of this to really get a sense of what the noise is and what the signal is. It's been really tough given all of the divergences, both within the data as well as in the earnings. Patrick Harker speaks at about 1 p.m. of the Philly Fed. It probably will reiterate what he said yesterday about pause, skip, whatever you want to call it. We hear from banking executives today, including Goldman Sachs' John Waldron, Bill Denchek of PNC, as well as Brian Moynihan of Bank of America. This is at that Bernstein conference. Very curious to see what they have to say about the consumer with a bit more of a bird's eye view. And I want to go back to those retail earnings. The idea that Macy's downgraded their expectations, downgraded their sales, just the idea that full year sales now they're expecting to be $22.8 billion to $23.2 billion versus the prior guidance of as much as $24.2 billion. That, to me, it really signals perhaps a very specific trend that we're not seeing in places like Nordstrom, but really do signal that there is some sort of softness out there. We get after the bell Lululemon, a higher end kind of retailer. Curious to see what comes from there. But Nordstrom shares are up today, John.
There you go.
And so this is the confusion. Is this a Macy's story or is this a broader issue? But Nordstrom did well on the off-rack brands, so the ones that were more discounted oriented. How much is this really an issue of strategy at a time when the economy is in transition?
Don't you find there's just something for everyone? We get ISM manufacturing. You went through the data later this morning. You look at manufacturing, it says ugly, economy not great. You look at services, brilliant. Look at the airlines, go to an airport, super busy.
This is why it's so confusing, and this is why I didn't say I had sympathy for the Fed, but I understand the difficulty in discerning what the trend is at a time where you have retailers coming out with some pretty negative projections, others coming out with positive, and the retailers and airlines are doing gangbusters.
It speaks to America. There's different things out there. I think of Kohl's KSS and the challenges they had in the last thing. This is middle America, mid-market America, however you want to gloss it over. To compare and contrast, try to get these banners up, Amy, as you can. On an EBITDA margin, we're on an NVIDIA frenzy. Talk about the profit of retail. EBITDA margin, Macy's, 10 cents, 11 cents in the dollar. NVIDIA, 40 cents in the dollar. Those are the profit machines everybody's focused on. And then you look at gross margin. I did this for you, John. And you got gross margin. You got Macy's at 39 cents in the dollar before a lot of other expenses come out. And LVMH it's almost a double, 68%. This is about mid-America flat on its back.
Let's get to the CEO's quote on what he's seeing right now. Jeff Jeanette saying this: we planned the year assuming that the economic health of the consumer would be challenged. Starting in late March, demand trends weakened further in our discretionary categories. That stock is getting hammered. Tracy McMillan joins us now, Head of Global Asset Allocation at the Wells Fargo Investment Institute. Tracy, do you think that's a story about Macy's, or is that a story about this economy?
So it's probably both. It's probably a story about the bifurcation of the consumer. The top two quintiles seem to still have purchasing power. The bottom three quintiles do not. And we're seeing much higher credit card rates. We're seeing much higher auto loan rates, and that is hurting the bottom end of the consumer. There's this mountain of cash that consumers had on their balance sheets, and we see that starting to dwindle now.
Well, you mentioned that to me, Tracy, before when we saw the shock of the Macy's news, and you're talking about a consumer that's dwindling away. Are they dwindling away into a legit NBER recession?
So we think so. We think that this is a recession postponed, not canceled. And as that mountain of cash dwindles, it should decline at an accelerated pace, especially as we see student loan payments starting to resume. At the same time, there's going to be more of a fiscal drag. And we don't think that the Fed is going to come in here and rescue markets. We don't think that they will be cutting this year. In fact, we see another rate hike.
Tracy, what data are you focusing on, given that there are these really divergent views depending on which data points you pick up on?
That's very true. The data is very mixed, and that's not uncommon at a turning point in the markets. One of the things that we're watching, especially this week, is labor market news. The labor markets are still very strong, but they're starting to slow down. In fact, tomorrow's Non-farm payrolls have an estimate of 235,000 jobs added, but we've now seen 3 months in a row, and this will make the 4th month of sub 260,000 jobs added. That's the first time since the pandemic that we've seen the payroll slow down that much.
What's really hard about the data right now is it really depends on what your bias is, how you read it. Some people say that they're seeing softening in the labor market. Other people say, what are you talking about? We just saw a JOLT survey that came in, surprised to the upside, blew all expectations out of the water. You could see those help wanted signs in every store around the country. You've got a lot of constraint on that point of view. What are you looking at to show this market slowdown? Or is it that everybody is looking for it and finding it, in places, and then kind of confirmation bias is sort of like, okay, well, that's what we should focus on?
Yeah, I think it's really looking at the traditional indicators of recession, seeing that those are pointing towards a recession, seeing a Fed that is actually convinced that they need to continue to quell inflation, continue to slow the economy. So actually those jobs numbers and the JOLTS survey are not good news for the Fed.
Tracy, asset allocation. Boy, it's mid-year correction. John Farrow's year starts March 31. We're deep into the Farrow year. How do you reallocate right now on a 60-40 strategy?
So we would be overweighting fixed income relative to equities, and we'd be up in quality in both of those asset groups. So we like large caps over small caps. We have moved developed markets back to neutral from an underweight. And within fixed income, we like short-term and long-term. We're barbelling that in investment grade over high yield.
Just within DM equities, is there a bias towards the United States?
There is a bias toward the United States in that we have overweighted the U.S. markets, but we are starting to add money back to European markets, mostly on valuation and the idea that the dollar is probably peaked.
Interesting. What tells you the dollar's peaked?
So we think that the dollar has probably peaked because the U.S. is probably near the end of its tightening cycle, but we don't think that the Eurozone is near the end of its tightening cycle. And the Japanese economy as well has been performing fairly well. The Japanese markets have been performing fairly well, and they too could see tighter monetary policy as the year progresses.
Just quickly then, what do you think explains the strength in the US dollar in the last month? Because everything you've said has been true consistently through the whole year.
Yeah, so we think that the strength in the dollar really is off of the debt ceiling deal. The dollar does tend to move up about 2% once a debt ceiling deal is reached. So we think that that's probably behind a lot of it, but in the Eurozone, I think that there's some discounting going on there as well, as Germany has tipped into recession.
Yeah, the data there's weak. China as well. Tracy, thank you. Tracy McMillan there of Wells Fargo. I'll catch up with Sam Linton-Brown of BNP Paribas a little bit later. So a lot of people come on, like Tracy did there, and they talk about how the ECB is going to do more than the Federal Reserve. Backed up by the ECB this morning, President Lagarde still have ground to cover on rates. You don't hear that from the chairman of the Federal Reserve in quite the same way. Got it. Sam Linton-Brown thinks it's less about that and more about the potential damage that will be done to the economies from the cumulative tightening already in the pipeline. And arguably what you're seeing so far, and this is my view on things and not his, is that what you're seeing so far is that the US economy is standing up to rate hikes better than Europe is right now, based on the weaker data we've seen so far.
It's the conflict right now in the FX market between just simply monetary policy versus economic growth. And that, I think, has been the tension, which has made it very confusing to figure out the right kind of direction here.
Other factors in the overwhelming first-order condition for America's technology. We own it. They don't.
Exactly. You can find NVIDIA on the NASDAQ. You cannot find that on the Euro Stoxx 50. I can get you some LVMH, though, Tom. Fancy it.
Well, what is it, 21% of the French GDP?
Not quite, but it's
Macron's closet is jammed with them, as I say.
Up next, we'll catch up with AMH down in Washington, D.C. The debt deal passes the House. Now it's on to the Senate.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. As Jonathan just mentioned, the House passed debt limit legislation forged by President Joe Biden and Speaker Kevin McCarthy that would impose restraints on government spending through the 2024 election and avert a destabilizing U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday evening.
Tonight, we all made history because this is the biggest cut and savings this Congress has ever voted for.
And that measure now goes to the Senate, where approval is virtually certain. Mitch McConnell says a vote may happen as soon as today. Serbia's president called for the removal of new mayors in northern Kosovo. The flare-up started last week as the newly appointed mayors started to take up their posts in northern Kosovo. Tensions escalated on Monday when Serb protesters clashed with Kosovo police and NATO troops, leaving 30 peacekeepers and dozens of protesters injured. And Amazon has agreed to pay just over $30 million to resolve two cases brought on by the FTC. Now, in the first case, the agency says the company didn't take enough steps to protect the privacy of users of its Ring video doorbell. The second case involves Amazon's Alexa-powered speakers, which the Justice Department says collected information about children under the age of 13 without their parents' consent. Amazon disagrees with those claims. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, Friday on Bloomberg Television and Radio.
Tonight, we all made history because this is the biggest cut and savings this Congress has ever voted for.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the President's desk as soon as possible.
Now it's on to the Senate. That was Speaker McCarthy and Senate Majority Leader Chuck Schumer. As Schumer pointed out, it's on to the Senate after a 314 to 117 vote in the House, passing with ease, but with a lot of help from Democrats. And I think that's the wrinkle in Speaker McCarthy's case. A good deal, Tom, in the eyes of a lot of people who voted for it, obviously, but that one small wrinkle, more Democrats voted for it than Republicans.
And that's a House debate as well. I would say the focus, maybe not on the zeitgeist now, but certainly tomorrow and into the weekend, is the Senate. And, you know, I think that's...
Do you think this drags or has the potential to drag? Maybe beyond this weekend?
I'm listening to experts. I'm not an expert on this. I'm listening to the experts, and they say, look at Paul of Kentucky, look at Mr. Graham of the Carolinas, and they've got a lot of reasons to slow this thing down.
Isn't that part of the game, though?
Yes.
Just sort
the
of
game
engineer
is
some,
exactly,
it might not
yes.
pass, you need my vote. Nah,
Give me a pipeline.
That was good.
Should I be worried? I'm trying to work that out. I think a lot of people are this morning. They just want to move on. Should anyone be worried?
No, I think the tone is we're moving on, but, you know, maybe others like Anne-Marie Horton would tell us not. What do you think, Lisa?
You should always worry, number one. But number
Here we
two,
go.
I would say
default position.
Default position should be worried.
That's the subtitle for the program.
We'll just
You
say
should
this.
always worry.
You should always worry. But it's a longer-term worry now of what happens with some of the serious issues that are clearly agreed to disagree upon and discussing.
I love it. This is great. So the surveillance newsletter, which, by the way, comes out when? 9:30?
About that, we try.
14 pages.
Right, so here's the plug. Go to bloomberg.com/surveillance, and you can sign up to that newsletter.
It's always
You should put at the end of that, you should always worry.
All right, I will, and I'll let you know why.
Why don't you do a little thing at the bottom, like you do a footnote on each page?
That's great. That's great.
Here's why you should worry.
Here's why you should worry.
Newsletter's been a huge success. This is all Bramo. It's a Bramo project. She's got how many interns on it?
I'm pretty sure that everything Bramo does is a success.
4 interns?
4 interns.
I think it's 4 interns because, you know, we're ramping up for the summer here.
Yeah.
It's really worked out.
Bramo taken 100% of the intern allocation this summer.
Oh, yeah.
About that?
Yeah.
The memo? Got the memo.
Yeah, I got the memo on that as well. Speaking of interns, Anne-Marie Horton will have 4 or 5 this summer in Bloomberg, Washington. Always a good place to do your internship. She's our Bloomberg, Washington and debt correspondent. Anne-Marie, I got a bunch of questions, particularly about Rand Paul, the senator, but I've got to go to Margot Sanger-Katz's essay in the New York Times about, I love this phrase, I just can't get over it, agreed upon adjustments. What's the ballet here? To get to the election of November of 24, to get to February, agreed upon adjustments means that what McCarthy said last night is a fiction. Where are they trying to get to? Where's the outcome of this?
Well, a lot of this has to do with this debt ceiling bills. There's a second part of this, and this will be happen in the government negotiations and the spending process in the appropriations meetings. And this is about government spending, but they have agreed upon the caps between the Biden administration and McCarthy. But obviously, many people are poking holes that potentially this could be more fudged. What you heard the speaker say, though, to Hugh Hewitt when asked about what's next, he said we need to continue this fight, take it into appropriations, and make sure we are getting rid of, quote, wokeism and eliminate some of this higher spending he feels like they have seen from the Biden administration. So this fight will continue, and it's why many people are poking holes into how much actually this deal would reduce the budget. The CBO says it's $1.5 trillion. I believe in that New York Times article, their analysis was more like $1 trillion. What I think is interesting is how the Wall Street Journal frames it this morning, Tom. They say that this sounds like a lot, $1.5 trillion over a decade. But that simply means that the federal debt, now 97 of gross domestic product, will rise to around 115% in a decade instead of 119%. And that's if you assume that the Trump-era tax cuts are good-nighted after 2025. So this is very small. That's the takeaway. It's a slice of a slice that they're able to cut because they're not going after the big parts of U.S. spending.
I want to get out front, Anne-Marie, of your path to next week, which is the ophthalmologist from Kentucky. What is Rand Paul going to do to block this process in the Senate? The guy won 62% of the GOP vote in a very Republican Kentucky. I get it. But is he really going to gum up the machine?
Well, as Greg Valliere calls him, an irritant at times for the Senate process. It's not just him, though. We should note there are other individuals who, listen, they at least want their amendments to be heard, whether it's Ron Paul, whether it's Mike Lee, whether it's Tim Kaine of Virginia, who's had some harsh tones and criticism of the White House because of the Mountain Valley pipeline that is in this debt limit bill. These senators, I think, at least want to make sure they can have their amendments on the floor. But I would say Mitch McConnell has done this how many times now? And what he has said is he could see a vote as soon as today. So I would say he has been working the phones to make sure he can get everyone in line. There is also this idea in Washington, and some political analysts were talking to us about this last night, this idea of jet fumes. It's close to the weekend. They're exhausted. They've had enough of this. A lot of them have been dealing this since January, thinking about how this was going to end up, the showdown of this would look like when the Treasury was using extraordinary measures to pay our bills, and they're ready to go home. There is potential for some cumbersome process, but there's also potential that a lot of this is being done in the background, and they might get out of here even before Sunday.
And now we get the spin cycle. Ron DeSantis going over to Iowa and saying to Trump, you're trying to lead. Where's your view on the debt ceiling? I already came out against it. What's your view on that in terms of whether we expect to hear something from Trump and whether this is going to be used as sort of the political football du jour?
I'm pretty sure everyone on the Republican side who wants that nomination has come out against the debt ceiling, barring the former president. But we already know what he's had to say about the debt ceiling, although his comments on the debt ceiling have changed dramatically. When he was president, he said he thinks it would be crazy for anyone to use the debt ceiling as leverage. Then, out of his presidency, he said it should be used as leverage when I'm not president, but should not be used as leverage when I was president. And then he also said recently that the Republicans should go up to the brink or even default to get what they want out of this. So his tune has changed a number of times, but talking about what Ron DeSantis is saying, he is in Iowa, he's leaving Iowa. The former president is now touched down in Iowa, this key state for Republicans, and he's giving a town hall with Sean Hannity. So I'm sure this question will be asked, and we can get his final thoughts on this McCarthy-Biden debt deal.
Oh, Bramo, if only campaign politics right now was just about that. It's not about that. AMH, is it DeSantis or DeSantis? What is it?
Let's say this. I have a lot of Italian friends and family messaging me, asking me why he's pronouncing his name differently. I think, depending on who you talk to, but the governor is saying DeSantis.
But hasn't the governor gone back and forth on that as well?
Yeah, as has his wife. His wife has pronounced it differently as well. I think it's DeSantis.
Yeah, but that's typical.
Don't we need to?
We'll leave it to the governor to decide how he wants to say his name.
Well, I think we need to agree on that before the campaign really gets going.
I would agree. We ask that all the time.
Amory, DeSantis?
Yeah, DeSantis.
DeSantis.
No, but you just said it differently.
Oh, make your mind up, AMH. Come on. DeSantis.
It's how much you emphasize the DEE part. Some people are saying he just wants it to sound more American. Obviously, his last name is of Italian roots.
Right, okay. AMH, thank you. Anne-Marie on the latest. TK, you're obsessed with the zeitgeist, so to speak.
Matters.
That's it right there. Yeah.
Well, politically, yeah, I think that's the zeitgeist. I mean, politically, I'm looking at the markets here. I mean, John, look at the market lifting up this
You're being
morning.
sensible for once. Okay, yeah, up by 0.2% on the S&P 500. Great note from Axios this morning, by the way, on that DeSantis stuff, but actually they led with something else. Is the Great Resignation over in America? Because the JOLTS numbers showed surging vacancies again, and that was the headline, and I've got all of that. Beneath the surface, the quits rate actually fell back to a normal kind of level, Lisa.
2019 levels. It was confusing data, so just ignore it for a month.
Oil just rolled over.
Okay. It's like market roulette with you this morning. I can't keep up.
It's fascinating.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Equities up in May, up in June for about 5 minutes. Welcome to June. Equity futures positive on the S&P 500, positive by 0.2%. Big run of gains in the Nasdaq, up for a third straight month, the third consecutive month of gains on the Nasdaq, advancing for a gain of almost 8% last month. This is what Citi's Stuart Kaiser had to say. The tech trade is far less clean than to start the year. We think outperformance is justified and don't see a compelling alternative at this time. That's the problem, Bramo. And I know you've read this note as well because I saw the quote you tweeted out just on where that performance has come from. Just a handful of names.
And the reality is that a lot of people don't see a reason for it to stop unless it's a tactical sell-off like the one we saw yesterday, which is a 5% sell-off for NVIDIA, but it doesn't really matter considering they've been up.
There's an alternative in the bond market, but within the equity market, there is no alternative still.
It seems like that's the case, and now it's a safety trade despite what's going on with yields.
Let's talk about treasuries. 2-year, 10-year, 30-year, 2-year through May, up 40 basis points. Trim some of that gain to close out the month. Yields up by a couple of basis points right now to 442.77. Just to kick off a brand new month with yields a little bit higher on the 10-year too, up a single basis point at 365.79. Just want to touch base with the euro just briefly. Had a look at 107 again today, 107.10. President Lagarde talking up more rate hikes, all of the above. But we are coming back off the back of the worst month for the single currency, for the euro, going all the way back to April, Tom, last year.
What's going on here? We don't need to do EM right now, but yeah, I agree, John, with the euro focus is really driving everything. I look at euro yen. It really hasn't broken through strong yen either way. Both of them are pretty fragile against the dollar.
You mentioned crude, 67 handle on WTI.
It's there.
Down by about 36 cents there, so it's a break of 68, down about 0.5%. We've got an OPEC Plus meeting.
100.
I do remember that, yeah.
100 pages.
Tom, based on how this year's gone so far, who knows where we're going this year? Crude. Don't we always say, if you want to make a fool out of someone in the market, ask for a forecast on oil?
Somebody came up to me in the street yesterday, I think it was Fifth Avenue, I can't remember, and they said, when did Bramo sell the barrels in her living room? And I said, I think it was like 95. She didn't top ticket. But she just, unloaded those 2 barrels out.
In and around 130 last spring, remember?
Yeah.
When that war really kicked off in Ukraine. Still ongoing. And I mentioned this earlier, but the team here at Bloomberg, I think summing it up well. On the one hand, you've got inventory shrinking. On the other hand, you've got data that's been weaker, specifically out of China. And that's where these triple-digit crude calls were coming from. Not all of them, but some of them. This idea that China was reopening, you'd get all of this demand coming through Bramo, and crude's not taken off in quite the same way.
It's been a mystery wrapped in an enigma. I will just say that oil has been sort of epicenter of the uncertainty of the economic moment. Also at the epicenter is retailers. I wanted to take a look at what we saw out of Macy's and Dollar General earlier this morning. Macy's, we talked about the disappointment. Let's just experience the earnings per share expectation for the full year. They now see it being $2.70 to $3.20. Previously, they saw as much as $4.11. So a significant downward revision to their earnings. They talk about inventory. They talk about the weaker economic situation. And yet we still see people buying airline tickets. We still see people eating out and borrowing more on their credit cards.
I mean, they're now in the control room with the margin study, Lisa. The margins are fine. the issue here is volume and pricing. I don't know pricing unit, but it seems like a unit demand issue.
Yeah, that basically net sales. They were downgrading that at a time when they also were trying to roll off some of their inventory. Dollar General also cited weaker than expected macroeconomic issues, which I think is interesting, saying that people are spending less. How much is this, to Tom's point earlier, a bifurcated retailer in terms of who the audience is? But then on Nordstrom's side, they actually delivered better than expected earnings. Those shares are up 3.6%. Talked about some optimism, particularly with off-rack. So basically their off-price rack store is doing better than previously. Their previous track record shows those shares up 3.6%. All of these retailers, though, John, are talking about a weaker than expected macroeconomic backdrop, a weakening one, where people are being more selective with their discretionary spending. So is this an issue of which company is able to manage that better versus really challenging, versus challenging whether the macroeconomic backdrop truly is weakening?
They always talk about the macroeconomic backdrop when things are bad. And when things are good, you never really hear about it. It's just execution, execution, execution. If you've ended up with excess inventory and you need to do significant markdowns, it's probably because the ordering wasn't too good. And that's going to differ at different places. And we saw a lot of that coming out of the pandemic because they were trying to make sure they had the right amount of inventory for the right demand backdrop, and things shifted really, really quickly.
It was confusing. Everyone's sat around in sweatpants for 2 years, and then all of a sudden they wanted to get back to work and wanted to dress up, and all of a sudden they went and you couldn't find dress pants anywhere because everybody was like, oh my goodness.
So they ordered tons.
Exactly.
And then it arrived and everyone went on vacation.
And then everyone went back to Lululemon, which is why I'm interested to hear what we get after the bell today.
Lulu later. Lisa likes Lulu. She'd just like everybody to know.
It's like the fifth time she brought it up today.
Said that today.
No,
is it like the next NVIDIA?
Is this a sponsorship
deal? No.
Is the Surveillance newsletter sponsored by Lulu?
Just in general, whether it's athletic, pick your brand, whatever you want.
Okay.
It's just that it's going in and out of style, sort of.
Is it in now? Is Lululemon in now?
Style Master. Q.
I'm just
go. Ready. Go.
It's Lulu sarcasm dripping.
No. Is Lulu in style?
There are some potential competitors at this point. Like
Okay.
Buari is another one that's coming out. It's another athletic
It's
brand.
cutting edge. I'm not up to date at all.
No kidding. I know. But you have a different kind of stealth wealth.
Stealth wealth. Stealth wealth. This conversation's going places, Tom.
Saving us is Deborah Cunningham, Global Liquidity Markets CIO at Federated Hermes. And if you're in Global Wall Street, stop what you're doing because this is the conversation for June, July, and it is those pesky money market funds versus deposits. Deborah Cunningham is expert on this. And back to Bruce Bent and the Reserve Fund of the early 1970s, Federated and Vanguard, among others, owned the high ground on developing the concept. Deborah, first question, easy. Are money market funds safe given the debt crisis and the gyrations we're going to see in full faith and credit short paper?
Before we start that, though, Tom, let me just tell you, I'm wearing no Lululemon, but maybe a little Nordstrom's. And I do like some of the retailers that are out there, more the services side, though, than the good side. Safety and soundness from a money market funds standpoint, it's there. Diversification is high,
Right.
short-term, high-quality securities, very short weighted average maturities. You're talking days and weeks, not months and years. You're talking about high liquidity, and the securities that are being purchased, oftentimes collateralized, if you're talking about repo or asset-backed securities, or the government with treasuries and agencies.
What is a basis point pickup on yield? Back in the early 70s, this was sacrilegious. It was un-American. Everybody's going to die, and Federated had the courage to persist through this with others like Reserve Fund, et cetera. What's a basis point pickup, and do you think it will continue to boom?
Right now, all of our products basically are yielding over 5%. So that's a pretty substantial pickup. When you look at, some banks that were trying to keep deposits, they were maybe paying 3.5%, 3.75%. Whereas those who were necessarily not all that excited about keeping deposits were still in 0, 1, and 1 handles. So there's a substantial pickup when you go from deposits, uninsured deposits specifically, into money market funds where you've got market rates, and those market rates are 5+% right now.
How far along are we, Deborah, in that transition from deposit accounts that pay you nothing into money market accounts that pay you 5%? Because we hear about the greatest outflow of bank deposits going back for 40 years.
Well, it started when interest rates got off of zero, and that happened obviously over a year ago now, Lisa. But I don't think it's picked up the speed in earnest that it will likely have when a peak in rates is reached and when actually rates start declining, which we think won't happen until 2024.
Wow.
Generally speaking, when you look at where money market funds gather the most amount of assets versus deposits, it's in a flat to declining rate environment, not in a rising rate environment. I think what made it a little bit different in the current rising rate environment is that we came off zero, and zero was held by the banks while it wasn't held, obviously, by market rates, and that made a difference.
As you speak, I just hear that sound. It's the sucking of liquidity out of the market. At a certain point, if you get an acceleration of these deposits, it could have a pretty material effect on the broader economy. I'm just wondering, can we say we're about halfway through of the deposit flight? Can we say that it's going to be even significant, more significant than people have expected? Or do you think that it's going to be this sort of gradual tick, tick, tick until the Fed starts cutting the rates more significantly?
Gradual tick, tick, tick. I don't think anything happens, overnight, because generally speaking, these are retail accounts. And retail usually is a little bit stickier, usually takes a little bit more time for decision-making processes to occur. So I don't think it's something that is, sort of a flight syndrome that occurs and destabilizes. I think it's something that ultimately is gradual and to a large degree just kind of assimilated into what's happening from an economic and an issuance standpoint. I mean, right now, if money market funds continue to gather cash with the amount of treasury bills that are expected to be issued in the marketplace to bring, cash coffers back up to the $500 billion trillion level, we want a lot of availability for purchasing those bills, and cash flow into government money market funds certainly will aid in that process.
Interesting. You wonder if that disrupts the banks. Once again, Deborah Cunningham of Federated Hermes. Deborah, thank you. Wonderful to hear your contribution. Amazing how divided things are. Tom, you and I and Lisa have tried to talk about this a fair bit. The cash trap, the reinvestment risk down the road. Bob Michael of JP Morgan Asset Management sitting in that seat yesterday talking about the risk associated with cash. So let's talk about that risk. You sit in cash, you get 5%, great. Sit in a 3-month T-bill, whatever. 3 months is up, okay. You get the money back. The money you get back is bigger. That's your yield. Wonderful. And then what do? You think about reinvesting it. You buy another 3-month T-bill. Okay, keep doing that. 5%, 5%. Okay. And then at some point you face a rate cutting cycle and you face the risk of not having that 5% there anymore. And what the likes of Bob Michael, and it's very divided at the moment, what the likes of Bob Michael are saying, sweet spot 5-year. Lock in rates, Tom, for, let's say, 5 years, take the belly of the curve. And that's what he thinks the sweet spot is. And Tom, on top of that, not just the yield, but something you've talked about, the total return of that as well. Return. If you do get that rate cutting cycle and rates come in.
The legend and my great affection for Dan Fuss of Loomis Sales, it's all about total return. And Mr. Michael, who's a grizzled veteran back to Scudder and Schroeder's, I should say, and Bankers Trust, you clip the coupon and he's adamant you will see a gain on top of the coupon, which begins to get back those bond losses of the last couple of years.
I'm just curious about whether inflation's going back down. If it's not, that's a different story. And that's where the bifurcation comes in.
There's a huge, huge debate around this at the moment. And TK, as you and I have said a million times over the years, getting into cash is one decision. Getting back out of cash is a much harder decision.
Wildly asymmetric.
Especially when you see these moves in the NASDAQ. It's like, should we go?
You're feeling
should
it right
we go?
now.
Chuck Grommer, Gordon Haskett on Macy's earnings coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's capital was hit by missiles overnight. Kyiv's mayor says at least 3 people were killed, including 2 children, by debris. NATO foreign ministers will discuss Ukraine's bid to join the military alliance at a 2-day meeting in Oslo today. Meanwhile, Ukrainian President Volodymyr Zelensky made an unexpected appearance at a summit in neighboring Moldova. The summit is taking place less than a dozen miles away from the breakaway region of Transnistria, which hosts Russian troops on Moldova's eastern border with Ukraine. Zelensky says he will hold bilateral meetings at the European Political Community Summit, where he will propose setting up a coalition of patriots. Former European Central Bank President Jean-Claude Trichet says despite an environment of great pessimism, Europe's boldest endeavor was the creation of the bank. He spoke to Bloomberg's on the ECB's 25th anniversary.
We also proved something which is very important, I would say, historical trend. We started with 11 countries. We are now 20 countries. In my 8 years of mandate, I welcomed 5 new countries, you see. So there is something underlying, which is very strong.
Meanwhile, Vice President Luis de Guindos says the ECB is in the final stretch of hiking interest rates, with further decisions to be data-driven. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The U.S. consumer has been strong. I do think, however, that the direction of travel for the second half of the year is one where a ton of headwinds are gathering momentum. So the U.S. economy is going to slow as well, and we're already seeing signs that the labor market is starting to cool down.
Seeing signs that the consumers start to cool down. Looking at Macy's this morning, that was Barini Urici there, the U.S. economist at T. Rowe Price. Here's Macy's right now, negative in the pre-market, with a pretty dreadful full-year outlook relative to what they told us last time around. We're down by close to 9%. They're talking about a weaker consumer this morning, Tom. Don't see that really in the airlines. Don't see that in the labour market, do you? You don't see it at some other retailers as well. TK, so what did you call this, Bramo? A mystery wrapped in an enigma?
An enigma,
Yeah.
surveillance.
Is that Macy's right now?
It's everything. No, yeah, it's definitely, it's the retail sector. It's the economic data in general. It's choose your own adventure.
It's true. I agree with you. Manufacturing PMIs, ugly. Services PMIs, decent. Michael Purvis this morning at Toolback and writing about that again this morning.
Out front on this is buy, hold, sell, and it's real simple. The hold means I'm not that enthused. Chuck Grom, senior retail analyst at Gordon Haskett, love having him on, and it is about this parsing here of a hold to a buy. Chuck, real simple. With this disastrous set of headlines from Macy's, you nailed it with a tepid hold. Does Macy's become a sell?
I think Macy's is still doing a really good job on a lot of fronts, and I think that's exemplified on the balance sheet where inventory levels are still really lean. Macy's is a victim of the circumstance right now, and you alluded to it. People are preferring travel, and with inflationary pressures out there, budgets are constrained. So I don't personally think Macy's is a sell. We downgraded the stock back in late March at $18 to a hold. We sensed that the guide for the year that they outlined was too optimistic,
right.
and today we're seeing that to a degree. But Macy's is still doing a lot of good things.
Okay, they're doing a lot of good things, but the fact is it's been a train wreck for 10 years. And then in the pandemic, it sort of came around, and I get that's come off the bottom a little bit. Do you have enough faith in management and their strategy to say I got a 3 or 5 year vector higher in Macy's, even if it's not back to 60 or 70?
I think that's all going to depend on the consumer and what happens over the next couple of years. In the near term, we definitely think the stock is going to stay under pressure. They did lower guidance by 25% this morning, which is a really big cut. Clearly, the stock had been under some pressure, and this was discounted to a degree. However, when you really unpack the guide, the fourth quarter, which is the holiday quarter for them, still does look aggressive. So another said differently, this might not be the last cut on guidance right now. We're just going to have to continue to monitor the data points across retail.
Chuck, you were brilliant last time we spoke. You said this was the discretionary recession. And Chuck, I think what we're all trying to work out around the table is what is this about Macy's and what is it about the economy? Which one is which? Is this a Macy's story or a story about the economy?
Yeah, well, what's interesting is this morning you have two companies guiding down, both Macy's and Dollar General. And if you think about the Dollar General customer, it's at the low end. Macy's is clearly at the high end. So you're seeing weakness across the board, whether it be low end, high end, discretionary. And we talked about that a couple of weeks ago when I was on post Home Depot. It's really just people preferring needs versus wants at this point in time.
Chuck, you said that Macy's caters to high end, and yet the luxury players are all seeing gains. Is that really the case, or is it really a question of identity? Whether they actually are high end, whether they're low end, whether basically they're the middle income kinds of shoppers that are probably going to be the most squeezed right now?
Well, I look at Macy's more high end, but clearly if you were to look at Nordstrom or even the Bloomingdale's banner within Macy's, that would be high tiered. But you look at a company like Restoration Hardware, which is really the most premier upper end company we cover, and you're seeing weakness there. So consumers just getting strapped right now.
Do you think that this is a temporary phenomenon as people sort of get the YOLO experience out of their belts and basically just keep flying around until they run out of money and then they'll go back to buying stuff again?
I do, actually. I do think that there'll be a time, and I'm not an expert in travel and leisure spend, but clearly people are over splurging right now, given that you weren't able to do that for a couple year period. So I do think at some point you'll see some balancing here across the board.
Can you talk about the difficulty of ordering the correct mix of clothing at a time that still is the pandemic economy, as we've been talking about pretty much over the past couple of months? How difficult it is to know whether people are going to want stuff to go back to the office, stuff to go work out in, stuff to go out on the town, or the casual back? I mean, how do you sort of parse out this quickly moving trend cycle?
It's not easy, and I'm glad that's not my job. But I do think that Macy's has done a pretty good job over the past couple of years, knowing where the trend's going to be. But that's one of the reasons why people like off-price, because the lead times on off-price are just so much shorter in duration. You're talking about buying stuff today for the next couple of months, as opposed to buying stuff today for next spring. Knowing what's going to be hot and what's not, 8 to 9 months out is really, really difficult. And that's part of the reason why, these department stores have just struggled over the past decade and have really given up a lot of share to off-price.
Are department stores dead?
I don't think they're dead. I think certain models are better than others. And I think, again, I'm not here to be super negative on Macy's this morning, because I do think that the team, and particularly their CFO, Adrian, has done a really good job managing inventory levels. Others, I think, companies like Kohl's have struggles, and getting foot traffic into those stores has been elusive for a really long time. And frankly, I don't know how they fix it.
I just find this absolutely important. And on a revenue and unit basis, this is just a lack of traffic into the stores. So what's your single best buy within retailing now? Is it a combined department store feel, or is it a specialty stock?
I think the best two names to own right now in retail are Walmart and Costco. And you'll tell me that's super defensive and potentially super boring, but sometimes boring can be good.
Interesting.
Costco is the best retailer I've ever covered. It checks all the boxes. And to me, Walmart, there's no better time to own Walmart than right now, both from a sector perspective and given how difficult everything is out there, and also from a company specific perspective. They're doing a lot of really good things. And I think the key theme for both companies is they lead with price. They're the lowest price guys out there, and what consumer out there doesn't want lower prices right now?
If you believe we're in a discretionary recession, quite clearly that's the place to be. Chuck, thank you, sir. Chuck Grom there of Gordon Haskett on the latest with some of the retailers. When was the last time we went to a Macy's, TK?
Long time ago.
Years and years. Haven't been for a long time.
They own other things as well, but I'm just looking at. I don't have a banner to bring up here. I'm sorry for that on TV, but John, it's simple. Costco, 10-year track record, 19% per year.
Sounds terrible.
Macy's, negative 8% per year.
There you go.
Do the math. 19.8. That's 2,700 basis points delta between Chuck Grom's Costco and Macy's.
This is the thing. Nordstrom and some of the others have really made the experience of a department store something specific and modern. And that's sort of the question with Macy's. What are they going to do with that? I mean, I do wonder, are they going to be sort of the closet where you can go try on stuff and then order it online? Or are they going to be something where you go and you buy it on the spot? I mean, it's a different story to sell than the Nordstrom that was saying, okay, we're going to make this whole experience, get a manicure. They push back a little.
My scientific analysis is simple. Third Avenue.
I don't know.
John, I don't know what
manicures.
Do
you?
No,
right.
I'm just saying, like, their services.
Inquiring minds want to know.
Third Avenue gets more and more jammed with trucks with boxes on them. That's all I know. It gets worse and worse every
Third
month.
Avenue. We should draw a distinction between Midtown East and Midtown West, because we had a guest on yesterday who was talking about where they worked. And where they worked was Midtown West, and there's a lot of banks up there, up 6th Avenue, up and down 6th Avenue. You can see them there. That's kind of busy. New restaurants opening up over there. Midtown East, dead zone. All the way down from like 50th down towards Grand Central. It's a bunch of hotels that went into the pandemic, never reopened coming out of it.
How much of it Hudson Yards basically eating the lunch
Sucking it
of
away?
Midtown East? I mean, because it basically was Wall Street moved to Midtown East, now moved to Hudson Yards. Is this basically what we're seeing at a time when overall the pool is shrinking and isn't going to come back? And what does that do to commercial real estate?
I would lean on the tech employment in New York. Cranes had a wonderful article yesterday on some document that Facebook had to put in showing their employment dynamic in the city. I think
Interesting.
We way underplay the summed tech employees, and John, they're way over on the west side as a general rule.
Don't they all want to work from home too, Tom?
Yes.
Tech employees.
Amazon was protesting. They walked out saying, we need to work from home.
Work from home protest?
Yeah.
What did they walk out from? The office or home?
Well, they're being mandated to go 3 days a week, and they were not happy.
I protest. I'm going to do 4-day weeks.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. U.S. Open champion Carlos Alcaraz had to fight to reach the third round after he came through against Taro Daniel in 4 sets. After losing the opener 6-1, the Japanese star leveled it in the second before the top seed closed it out 6-2 to advance. Alcaraz is on course to meet Novak Djokovic in what would be a blockbuster semifinal in Paris.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1, so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Investors are seeing cracks forming, and they're trying to get out of the way.
We are headed towards slower growth. I think you're seeing that in Europe now. You're seeing that in China.
China's not in good shape right now, and I think we are looking around and seeing what is going to pull China out of the doldrums.
The economic data, not great across the globe, but it's actually better in the U.S. right now.
The U.S. will not be as strong in the second half of the year as it was in the first half.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Cancel the Thanksgiving parade. Macy's challenged, troubled, down 9%. Really can't get a bid right now. It's going to be an interesting conference call on what they do the fourth Thursday of November.
We've got some questions, haven't we? Is this a story about Macy's, or is it a story about the U.S. economy going into payrolls tomorrow? The estimate in our survey is 195,000. Unemployment potentially climbing from 3.4% to 3.5%. Clearly things are bad at Macy's, Tom. Are they that bad for the consumer?
It's a roll-up. I mean, I'm talking about zombie roll-up here. March 2005, John. Bon Macy's, Burdeen's, Goldsmiths, Lazarus, Riches. Macy's is a agglomeration of middle America. And is it a middle America in recession, even though the fancy people are doing well? Maybe that's the metaphor this morning.
You raised the question, Tom, with Chuck Grom of Gordon Haskett. Is the department store dead?
Yeah.
Is it dying? Yes. Is it dead?
It's a loaded question, and I think it depends on what level of store it is, the perception within the public. I mean, I'm not an expert on it, but there seemed to be a lot of traffic in selected specialty stores in the upper scale area versus really some serious damage at Macy's. I mean, if you're just joining us, folks, these Macy headline numbers, I'm not going to go into them now, but there's some significant line-by-line damage there.
Well, if you are just joining us, I'll share them with you. The full-year outlook for adjusted EPS, 270 to 320. They had seen previously 367 to 411. So the low end of the range last time around, not even the high end of the range this time around.
Nice. Yeah.
And that's when you know you've got a problem, Tom.
You got a problem there. You wonder how it folds into Jobs Day. We've got claims coming up here in 28 minutes. Early Jobs Day this month. On June, ISM Day. What do we see from ISM? John, you hang on ISM at 10 o'clock.
Look,
what's
manufacturing in recession. Gordon Haskett, Chuck Grom there said discretionary recession. Okay, well, manufacturing's in recession as well. Based on the PMIs, which are deeply contractionary in Europe, in China, and Lisa, in the US as well.
And this is why it's been so confusing, because if you look at those recession, if you look at the guidance from Dollar General, from Macy's, looking pretty negative. And then you look at American Airlines, you look at Southwest even coming out and actually increasing some of their forecasts according to reporting by Reuters. You can see people are still traveling around, still eating out, and you do see the economy propped up. How do you pair, Tom, the idea that Challenger Gray and Christmas Inc., this job sort of view that comes out, are seeing planned layoffs quadrupling this year, and pair that with a 3.5, 3.4% unemployment rate?
I used to hang on Challenger Gray, and I don't anymore. Michael McKee taught me to do that. But with that said, the job numbers are important. And, John, the survey is under 200,000. It's dipped down to a 195. It's not a big difference, but it's directional sort of into tomorrow's report.
There's multiple ways of looking at the same thing. There always are. But 200K with unemployment at 3.4. Still a pretty decent read, isn't it?
Yes. No, it's better than pretty.
If I said take a guess, and I often reflect on this Jackson Hole speech from Chairman Powell, we did that a little bit earlier, but if I said take a guess back in August of last year when he was talking about jacking up rates, Brammer, and causing pain, if we'd guessed that going into the summer of 2023, unemployment would be at around 3.5%, I think a lot of people would have laughed.
And a lot of people would have said, you need to actually see the pain that he's talking about. And right now what you're seeing is the exact opposite on the Fed, and actually saying, look, the pain is going to come. You'll believe it when you see it. We're going to just take a step back, figure out what the damage is, and not go further.
It's a process. It's happening slowly, Tom.
There's a process in Washington as well. 30 seconds here, debt ceiling. What are we watching today?
Through the House, needed the Democrats on board, onto the Senate. Hopefully get a vote and pass this thing going into the weekend.
Anne-Marie Hort, another ruined weekend. I mean, there's no question.
Potentially, potentially.
No question about it. I don't know, red and green on the screen. What can I say about the NASDAQ? 14,310. Sell in May and go away. NASDAQ, John, up 8% through May.
Strip out the muscle of big tech, Tom, and the equity market not doing much. Just monster outperformance, relative outperformance from the NASDAQ versus the S&P. S&P barely squeezed out a month of gains on the S&P 500 through May. The NASDAQ up by something like 8%.
Wall Street Journal, surveillance workers to be allowed to work remotely 2 days a week.
I like that.
Officials say. New York City workers.
New York City workers.
Yeah, I don't think that's us.
Okay.
There's a headline as well.
2 days a week, that's kind.
Yeah, it's kind. Yeah. Victoria.
Interesting that the mayor at the same time, Tom, is trying to say everyone needs to get back to work in the city.
But this was, and just the backstory here is, they said everyone needs to get back to work, and people said, okay, I quit, and they couldn't hire enough people, and there was this huge backlash. So this is sort of the concession at a time where they want everyone to get back to the office, but still need to be fully staffed.
I can't cite it, but somebody had a brilliant long piece on childcare in the last 24 hours.
It's a massive issue.
The charts are frightening. I mean, this is a huge, huge issue. We don't have time for that right now. Victoria Fernandez is with us, Chief Market Strategist at Crossmark Global Investments. I love the back end of your essay, Victoria, where you talk about the fight is to have your clients in private wealth management not throw in the towel.
Yeah, I mean, look, you're talking about all the different elements that are going on in the market right now. And a lot of it, even though we've said this for the last year, a lot of it is really fighting against each other. You have this one element of the market, the tech, the AI-related tech names that are really strong. You guys were just referencing the difference between the NASDAQ. You compare that to the S&P, the cap-weighted S&P, and then to the equal-weighted S&P. You're at one of the widest margins that we have ever seen. So at some point, those have to come back together. We don't want to sit on the sidelines and have just a very narrow breadth in our portfolios like we're seeing in the market. We want to have some of that diversification. So no, don't throw in the towel, but go in and find elements that you think can still do well in a volatile market and a economy that we think is going to be slowing at the end of this year, but still supported somewhat by a consumer, with manufacturing coming down, but savings rate and discretionary income still holding strong. So there are elements you can work with, but you have to be choosy.
what did we learn in the first 6 months of 2023?
That's a loaded question there, Lisa. I think we learned that we can't say everything is like it always has been. Things have happened very differently. You have a bond market and an equity market that are not reacting to each other the way they have historically. You have us going to the brink again on a debt ceiling. That probably is things like we've seen before, but pushing it to the limits and causing the market to react the way it has, pushing up short-term yields to 5.25%, 5.5%, driving people into the short-term treasury market, out of the equity market. These are all things that have been very different this year because we walked into an economy in a different manner with a pandemic than we had before, supporting a consumer. So I think we've learned that you have to be cautious. I think we've learned that you have to be tactical in this market, but I also think we've learned that you don't want to try to jump in and out all the time. Use your fundamental analysis to build strong portfolios.
Where do you fall on this debate, which is a really pretty bifurcated debate on whether inflation is going to rapidly decelerate heading into the end of the year or whether it's sticky? I mean, this really has been the core disagreement among the JP Morgans of the world and the BlackRocks of the world. Where do you fit in this?
I'm more leaning towards we're going to have some stickier inflation. Not that we're not in a downward trajectory. We can be on that headline number, although we've seen core CPI numbers actually hold steady or move up a little bit over the last few months. So I think you've got that sticky component, and it's not just going to be housing. Although you look at Zillow rents, those are up over the last month. Housing is rebounding. We heard Michelle Bowman saying the rise in housing costs is actually working against what they're trying to do on inflation. So I think we're going to have a stickier number. It's going to come down slowly, and I'm not sure that's going to be enough for the Fed, which is why I can't say there's a zero probability that you get more Fed rate hikes in the future.
Tell me about 60-40 right now. I mean, I've been looking at the numbers over the last number of weeks, sort of like, halfway through the year, beginning to chew on it, and I just don't get it. Are you overweight equities or do you hide out in bonds?
Well, yeah, the 60-40 was always kind of the go-to for everyone, and I think you have to be a little more tactical than that right now. Going back to some of the elements we talked about, Tom, the breadth in the market being so narrow, it's hard to have a 60% allocation and have that outperform without having high concentration in those names, which is not something we want to do. So yes, we think you should be adding to some of your bond allocations. We had a client call us last week and say, here's another $2 million, and we wanted his cash alternatives all in short-term treasuries to take advantage of those yields. You have to be careful with reinvestment risk when you do that, when you put all your eggs in that basket. But buy some bonds along the curve. Put a little heavyweight on the short end, add some on the longer end to lock in yield for longer. And that gives you a little bit of buffer against equity market volatility that we think we're going to see as a mild recession comes into play later this year.
If you've got a spare $2 million, 1-800-Fernandez TK. Just make it happen. I've got a spare $2 million. Want to throw that at some T-bills. That's the life, isn't it, Bramo?
Yeah.
Playing golf.
Yeah. Money market fund.
How many people?
Just complete the front nine. Just got some $2 million. Just throw out some T-bills.
Is that what you do at night?
Yeah. Every night.
Trying to figure it out.
Call Victoria and ask for $2 million worth of T-bills.
I run in money right now. I'll tell you, it's brutal. It's brutal. There's no other way.
It's pretty fun though, Tom.
It's fun, but
boring it's been at times.
Okay, but if you're not in 12 selected winning theories or guesses or whatever,
agreed.
No fun.
Well, this is the year that macro trading has kind of died. And other people might disagree, but it's been really hard to get any of those calls right. But if you look at the micro trades and the specific names, stock selection, I keep hearing that. And you are seeing different stories kind of pop up. Getting them right's another story. But I mean, maybe that's a lot more fun than it has been when the Fed's just like, we're going to tell you to buy. And everyone goes out and buys. Or they say, we're going to tell you to sell. Actually, that never happened.
Having a great time in foreign exchange. Just having a great time.
But what are you tracking? I mean, honestly,
it's just beating up consensus positions.
That's what you
and loving it. Oh yeah. This counter trend move in the euro in the last month.
That's
the dollar. What you're doing with your $2 million.
John, we got Steve Englander in 30 minutes.
It goes from close to 111 and have a sniff of 105, 106, just like that. Fading data out of China. Got the itch, Bramo. Futures on the S&P positive by 0.1% from New York. This is Bloomberg.
today with news from around the world. With the first word, I'm Lisa Mateo. Ukraine's capital was hit by missiles overnight. Kyiv's mayor says at least 3 people were killed, including 2 children, by debris. Meanwhile, Ukrainian President Volodymyr Zelensky made an unexpected appearance at a summit in neighboring Moldova. The summit is taking place less than a dozen miles away from the breakaway region of Transnistria, which holds Russian troops on Moldova's eastern border with Ukraine. Zelensky says he will hold bilateral meetings at the European Political Community Summit, where he will propose setting up a coalition of patriots. NATO foreign ministers are discussing Ukraine's bid to join the military alliance at a 2-day meeting in Oslo today. France and Germany are split over Ukraine's NATO appeal. France is pushing for a concrete path for Ukraine to join the NATO military alliance, but Germany is urging more caution about discussing membership in light of Russia's ongoing war. The U.S. House has passed the debt limit deal struck by Speaker Kevin McCarthy and President Joe Biden to avoid a catastrophic U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday night.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the President's desk as soon as possible.
Mitch McConnell says a Senate vote may happen as soon as today. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're getting close to a point where we can sit for a little bit in terms of policy. I don't know if we're exactly there yet, but I am in the camp increasingly coming into this meeting of thinking that we really should skip, not pause. I don't like the word pause, but skip an increase.
The state of Fed speak right now. Philadelphia Fed President Patrick Harker there. I don't like the word pause, but we can skip an increase. I don't necessarily think it's their fault. I think actually it's the market participants who believe a pause is ultimately the next step towards cutting. And that's something the Federal Reserve doesn't want to communicate because we had all these cuts priced in the back half of this year, which they wanted to lean against and get this market to price out.
I'm just saying, if I had said that, you would say you're getting soft. You're not saying it's their fault.
I've said that before.
But they're in a difficult situation.
I don't have sympathy for them.
Oh my goodness. What is the difference? I mean, honestly, they're in a tricky spot with a market that is going to respond in a way that's counterproductive and an economy that's really uncertain.
They're in a tricky spot.
Yes,
I just don't have sympathy for them. All right, for many reasons, and we can talk about those reasons later. We've got some data. Look at that. Mike McKee's here. Hello, Mike.
Hello, guys.
Nice to you.
And this is data that is going to lean against Philip Jefferson and Patrick Harker yesterday. ADP comes in at 278,000 jobs for the month of May. That is significantly higher than the 170 that analysts had expected. The April number revised down to 291,000 from 296, but that's neither here nor there. And we don't really look at ADP as a predictor for the jobs report on Friday, but in this case, they have been coming in lower for the most part than the non-farm payrolls number. So this is something to keep an eye on here. We're wondering how strong the economy is.
Jobless claims coming out in about 14 minutes. Don't you just feel sorry for them? Right now at the Federal Reserve.
Oh, come on.
Yields up 4 or 5 basis points. The 2-year, 4.45. Mike, just quickly, how should we read claims in 14 minutes? All these, I don't want to call them distortions, but disruptions to the data over the last few months. What's the read on this later?
Yeah, I think basically what you have to do is sort of look at the trend as opposed to the number, because the numbers have bounced around, part of it fraud. And we should be seeing a rise in claims if the economy and the labor market are slowing down. And we can't really say that we have seen that yet. So if we get the same kind of numbers that we've been getting, it looks like the labor market is going to be really strong still going into the Fed meeting on June 14th.
Mike, thank you, mate. Claims, Tom, about 13 minutes away.
It's going to be huge. It's weekly data. I take a 4-week moving average, try to smooth it out a little bit. But, yeah, the fraud thing hangs over it. just more data of what is somewhat a fully employed America. Writing about that has been William Dudley, former New York Fed president, Bloomberg opinion columnist. He has been absolutely 100% on of a central bank looking for higher interest rates. Bill Dudley, thank you for joining us off your essay with Bloomberg Opinion. You quote the Clash, you channel back to London Calling. Guess what? The Eccles building is calling. Do they have to wait for the data, or can they get out front?
Well, they're going to take a pause because they believe that there are long and variable legs of monetary policy, and so they want to see the effects of prior actions. But they've characterized it as a skip because they think that they'll probably have to do a little bit more. And we'll probably see that in the summary of economic projections. We'll probably see a couple, one or two additional rate hikes penciled in for 2023. The economy really hasn't slowed much at all. If you look at the Atlanta Fed GDP now forecasts for the second quarter, it's 1.9%. And as you were just talking about, the labor market still seems very, very strong. So the Fed hasn't really accomplished much yet.
Bullard of St. Louis and Indiana University uses his economics to say we can do this exercise and avoid some form of NBER recession. Do you agree?
I think it's made very hard to avoid a recession if you believe that the Fed has to push the unemployment rate up by a meaningful amount. If you look at the Fed's own forecast, they think the unemployment rate is going to have to rise by at least 1 percentage point. Every time it's risen by 1 percentage point since World War II, we've had a recession, 12 out of 12. So I'm betting against a soft landing this time as well.
Bill, the implication here that the Fed hasn't really accomplished much and that they should go further with respect to hiking rates, that perhaps a pause or skipping or whatever you want to call it is perhaps not the right approach. What's the consequence to that? Do you expect this to actually accelerate inflation or keep it higher for longer in a way that people aren't really expecting?
It doesn't really matter if they hike in June versus July, as long as they keep financial conditions from easing significantly. And I think that's why they're using the language of skip rather than pause. They don't want the markets to think that they're finished because they don't want the stock market to rally a lot, bond yields to fall. If that were to happen, that would make monetary policy, the impulse of monetary policy, more stimulative and would be counterproductive to what they're trying to accomplish, which is to cool off the labor market.
The data's been really confusing. We've been talking about that all day, whether it's earnings or whether it's just the macroeconomic inputs that we normally have used. What are you looking at to really highlight that there's still a lot of strength that, frankly, the lag effects are not going to take care of?
Well, I think the labor market is the key thing to focus on. What's happening to payroll employment growth? What's happening to the tightness of the labor market? As, for example, the JOLTS report yesterday showed an increase in the number of unfilled jobs relative to unemployed workers. We're back to 1.8 unfilled jobs for every unemployed worker. Chair Powell in the past has said we need that ratio to be down around 1 to 1. And also what's happening to wages. Powell in his last press conference was very clear. He thinks wage inflation needs to be 3%, not 4 to 6%. To be consistent with 2% inflation. So the labor market and wages, I think, are going to be the key drivers of the Fed feeling more comfortable that they're actually on a track to 2% inflation.
Some people will say, well, we are seeing disinflation, and it actually will happen much more rapidly heading into year end. From your vantage point, the longer that it takes, does that create a stickiness that people are underappreciating? Or do you think that this is just simply they need to get back down to their goal? They want to get there sooner than later, just simply to remove that tax from lower income individuals in particular?
They think it's going to be a pretty drawn-out process. We really don't get back to 2% inflation for a couple of years on the Fed's own forecast. I think they're not concerned about how long it takes, as long as inflation expectations stay well anchored. The risk, of course, if inflation stays higher for longer, inflation expectations could become unanchored, and that would make the Fed's job more difficult. So they want to keep a close eye on inflation expectations.
Bill, we're not thinking too hard today. I don't need it to 2 or 3 decimal points, but I'm fascinated what your math is on a slower China and their machinations exporting disinflation or outright deflation. You and I have seen this over 30, 40 years as a theme. Are they going to adjust our lives because they're exporting price decline?
I think what's going to happen in China is we're going to see more stimulus. End of the day, that they're going to want to have growth because growth generates jobs, and jobs generate political stability in China. So I think what we'll see is more stimulus out of China. I do not expect the Chinese impulse back to the U.S. to be significant. We already are having goods disinflation. The problem in the U.S. is really in the services sector. China might add a little bit to that goods disinflation, but I don't think it's meaningful in terms of changing the inflation outlook.
Do you have any kind of vector of disinflation with services at this time, or do you just simply need more data points?
Well, the one thing that we know is coming is we're going to start to see declines in shelter prices as measured in the personal consumption expenditure deflator. We know that was going to happen with a lag, and that lag is about to arrive. The problem is, Chair Powell has indicated, is services inflation, excluding shelter, that's still very, very high. And as we've seen in the core PCE deflators that we've gotten over the last 6 months, we're stuck in this channel between 4.6% and 4.8% on a year-over basis. It's not falling. It's basically been flat.
I think that's called sticky, John. I think Dr. Dudley there identified the range-bound necessariness of the word sticky.
I've got some good news for some people. I'm not sure what your positioning is like at home, but for those of you long European vacations, the euro, another break of 107, 106.
You're looking at that to 5 digits, aren't you?
Yeah, for many reasons. The dollar stronger, the euro weaker off the back of this pretty robust data in America. Yields higher by, let's call it 3 basis points at the front end, 444. Equities, Lisa, just rolling over, just briefly, now unchanged on the session.
Which might come partly on the ADP report that nobody trades until they do, and this idea that if you have a stronger than expected employment reaction, that will actually create more pressure for the Fed. Bill, I want to just finish up with you on that point. Do you think that it is a foregone conclusion that regardless of what the data is, regardless of the jobs report we get tomorrow, they are not going to hike rates this month? They're going to try to signal, it doesn't mean that they're done, but basically they are not data dependent for this particular meeting?
Well, I think the data would have to be very, very strong to convince them to move at the June meeting. They basically are concerned about the long lags of monetary policy, and that belief should not be influenced by the strength of the data. So I'd be very surprised at this point, especially given Philip Jefferson's remarks yesterday, that they would actually go ahead and tighten at the June meeting. But July seems, almost likely at this point.
That felt like a rallying cry yesterday, didn't it, from the presumed Fed Vice Chair? It really did. Bill, thank you. Bill Dudley there, former New York Fed president, Bloomberg opinion columnist. Data dependence, the most meaningless phrase in the lexicon of the Federal Reserve.
It just got thrown out. I think that's what I heard.
It means nothing. It means whatever they want it to mean. And it's always meant whatever they want it to mean. We're data dependent.
Which data? The data
exactly.
next month? The data in 3 months?
How much weight are you putting on it?
How much data are you going to have in your input?
I blame Mike McKee for this.
Okay.
I do. Mike McKee, how data dependent are they?
They are data dependent. I'd be a little more hawkish than Bill in terms of the possibility of a June rate move.
Interesting. Why?
If CPI comes in very strong. Now, I think part of what may be going on is that they wanted to knock down this perception that they were locked into a rate increase, because then if they didn't, if the data came, they're not going to be able to tell us what they think of CPI. If the data came in softer, then it would be harder to turn on the market that way. So if they can keep giving themselves some options, this is interesting. I'm watching the Fed funds futures. Remember, we went from 68% yesterday to 38% today. Now we're at 29%, even though we had this strong number.
Kind of de-emphasize the importance, Lisa, to your point, of the incoming information between now and June 14th.
Data dependency no longer for the next month, and then it'll be data dependent.
For the next 2 weeks, and then we're done. Okay, then we're back to normal. All right. In the next hour, Michael Kondopoulos of Richard Bernstein Advisors, Kathy Jones of Charles Schwab, Sam Linton-Brown of BNP Paribas. Those conversations coming up on Bloomberg TV in about 30 minutes from now.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance into claims, and Lisa O'Brien was publishing moments ago. Dana Telsey Advisory Group, seeing, quote, limited visibility on Macy's. Not a scathing note, but it is a market perform, tough year ahead note.
Well, and that certainly seems to be what people are readjusting to, those shares lower by about only, at this point, 4%.
You wonder if there'll be claims from Macy's as they right size from C to shining C. We will turn to Michael McKee now on the anticipated weekly data, other stuff as well.
Yeah, other stuff including unit labor costs and non-farm productivity. These are the revisions to the first release for the first quarter, and we see non-farm productivity down 2.1%. It had initially been reported as 2.7% negative, so a slight improvement there. And unit labor costs, this is interesting, initially reported at 6.3%, comes in at 4.2%. So that is a big change, and it will be interesting to go under the hood in these numbers and see why they changed that way. Jobless claims is the number everybody's been following, and we talked about the trend. 232 for the month, for last week rather, and the week prior was revised up to 230. So almost no change in claims. It doesn't look like the labor market is getting any weaker. Now we've had three numbers: the JOLTS numbers, the ADP numbers, and the claims numbers.
And your summary?
Suggest strong. Well, my summary is that if you were a betting person, and we got one more number, the ISM employment number coming out at 10, you would probably be marking up your payrolls estimate. The private payrolls estimate right now is 164, and with ADP coming in at 278, that's more than 100,000 difference. So somebody's going to be really wrong.
I mean, I look at this, Michael, and you know, we're going to have Kathleen Bostjancic with us here in a moment, which is wonderful. But have you ever seen it like this, where there's, you know, coming out of a pandemic, coming out of a medical disaster, the Biden stimulus and all the rest, have you ever seen the cacophony sense of it like we're in right now?
Well, we haven't seen it, the Fed cacophony that we have now, the divisions among Fed officials for quite some time. The data are sort of in all different places. So the Fed is in all different places. What's interesting is we tend, as economists and I think as monetary policymakers, to fight the last war. And you think of what was happening after the financial crisis, when everybody kept expecting strength and it was slow. Right. Now we're expecting slow, because that's what the models are suggesting, and it hadn't happened yet.
Lisa, let me do the last market check. That's a joke there, the last war. Last market check. We're going to continue to do market checks today. 10-year real yield, 1.45%, comes in a little bit. I'm going to call it quiescent. I guess is the summary of the data. I see a little bit lower yields.
I actually find it more interesting than quiescent, because what you did see was jobless claims coming in lower than expected, right? A downside surprise, although pretty much in line, but showing that it's lower. But that's not what the market's responding to. What the market was responding to is the revision of the unit labor costs coming in.
Yes.
And so yields lower, significantly lower, even though, as Mike said, on the margins, this points to a labor market that would be strong, signifies the bias right now to a Fed on hold, to a Fed that doesn't want to go further. And that seems to be what's getting priced into the market.
Well, and the thing is, this is also first quarter data. So we're now 2 months into the second quarter. So it's old numbers, but still makes a case maybe inflation could come down.
Right, but that seems to be what people are banking on, and whatever the view on whether that's accurate or not, that's where the bias is. What is your view on the incredible revisions, the amount, the degree to which the data was wrong and has to get revised in another direction? Has this ever been seen before?
Well, we always get revisions because the data are incomplete when they're first published, but we are seeing big revisions now, I think, because the various statistical agencies are having trouble with seasonal adjustment coming out of the pandemic. The pandemic messed everything up so much. Just try to graph jobless claims these days, and you get the distortion.
The distortions are still there. I strongly agree with that. We see that. Michael McKee leading our coverage tomorrow at 8:30. We'll go beneath the headline data on an early June jobs report. She's still for that as well. Kathleen Bus-Johnson joins us now, chief economist, Nationwide Mutual Insurance, with the sum of this strange economy. It's as simple as this, Kathy. We've got retail, witness Macy's today, is a statement flat on its back. We've got other parts of the economy doing better than good. Do you aggregate it together? Or are you looking at 2 or 3 or 5 Americas?
Oh, good morning, Tom. Yeah, I think you hit the nail on the head there, is that you really have to bifurcate and differentiate among different consumer buckets here. You've got the upper middle income, upper income households. The labor market's strong, earnings strong, equity market's doing well, housing prices holding in there. They've come down a little bit, and still a lot of pent-up demand to spend on services. And let's not forget the savings, right? There's related savings that were accumulated during the pandemic. So that sector's still feeling pretty strong and spending. I think when you get beneath that, that's where you see the impact from inflation and even interest rates. And that portion, like the bottom, certainly the bottom third, maybe the bottom half of consumers feeling the pressure here.
So what does this add up into, Kathy? Does this add up into an economy that's slowing substantially, where the lag effects are going to take hold, or one that people are just missing the forest for the trees here that's a lot stronger than what a lot of people are anticipating?
Yeah, it's been very difficult to call the path of the economy and the timing, but we're still in the camp that it is delayed, the recession, and it's not postponed, delayed, but still coming. We look at the leading economic indicators, and they're still all pointing to recession. And I think the stronger, consumer spending, labor market remains for now, right? Those are coincident indicators. Just more, the Fed's going to be inclined to raise rates. And I think eventually the Fed's going to be successful. They've got to cool down the labor market, cool down consumer spending to cool down inflation. It just may take a little longer than they would like, and maybe the rest of us would like.
Well, you said that they're inclined to raise rates, and yesterday it seemed to be a bit of a different tone from Philip Jefferson, the vice chair of the Federal Reserve, and a number of the others, Patrick Harker among them, basically signaling a willingness to skip this next meeting, call it whatever you want to call it, and not raise rates, wait for the lag effects. I mean, do you think that is the right approach, that basically if they just stay on hold, this is where rates should peak out, and you will see that slowdown that will eventually bring inflation a lot lower?
Yeah, our baseline is that they do pause and hold it there, but I think the risk is, even if they skip the June meeting, that they could come back in July and raise rates. They are assessing things, and I think underneath all of it, even once we get beyond data dependent, I know we can debate whether they truly are data dependent, but what I think it's clear is they still have a tightening bias. It doesn't mean they will necessarily tighten, but they're still inclined to tighten before they certainly cut rates.
Kathy, Augusta Seriva is publishing on ADP today for Bloomberg News. And our economics team has a huge observation that wage growth is slowing. And here's the operative adverb, substantially. Do you agree with that? I mean, is wage growth really coming down where even with lower inflation, it's going to be problematic in terms of real wage growth?
We see it more gradual, Tom. Obviously we'll see what the data bring us tomorrow, but all of the signs we're seeing is that the labor market's still pretty tight, and demand for workers, especially certain sectors, really strong. Right, we saw that in the JOLTS data. So I think it's a gradual process, and same thing with inflation. So the pressures are still there for workers. The supply hasn't really come in line with demand at this point. And it'll just take a while for that to play through. And looking at the productivity numbers and particularly unit labor costs, it was interesting. It's old data, Q1. But I guess a nod to the idea that maybe we are seeing wage growth compensation come down. That was a figure that was revised lower.
Columbus, Ohio, unemployment rate, 3.40%. How can you talk of cutting rates given that single statistic? I just don't get it.
Well, and this is really the issue, especially if there is 1 or 2 or 16 states where the unemployment rate is a lot higher. And that sort of divergence is something that Bloomberg Intelligence picked up on yesterday, where they were pointing to the idea that 16 states, according to the SOM rule, have already basically entered recession with material increases in their unemployment rates. How does that complicate, Kathy, the whole dynamic when you do have such a bifurcated picture with some people experiencing a recession very much in a tangible way right now?
It's a great point. It is very difficult. The post-COVID economy, it just has skews and differences across sectors and the economy and geographically as well. Makes it really difficult for the Federal Reserve. Right? We've had the manufacturing sector, it's in recession. Housing's in recession, although maybe it's bottomed out, but the service sector right now is very buoyant, and that's where all the inflation is, right? So they're one tool, that's what they're stuck with.
Kathy, I got to make some news here. Help me out, please. Adjust your non-farm payroll statistic for tomorrow off of ADP and claims. Are you going to lift that statistic up?
Tom, we don't do that. In the past, it's not been a great correlation. We are above consensus for what that's worth. We're at 205,000. We could have had a lower number, but I think
there we go.
Economists have been missing on the downside. So we're comfortable with about 200,000. We do think things are slowing, but we're certainly not seeing recession signs in the labor market yet.
So, Lisa, that wasn't we made news, but we made sort of kind of like news, right?
Well, Mike made news, Mike McKee.
Mike
when
McKee
he was
always
basically
makes
saying
news.
that
Financial TV. Down in flames with Bus Johnson. Kathy Bus Johnson, thank you for the non-news at Nationwide Mutual Insurance. Truly one of my favorite people in aggregating the domestic economy. I give her an equivalency with Jim Glassman over at J.P. Morgan. She's just got this great handle on the dynamics of it. And I'm sorry, we have our own bias in New York and the outrageous real estate costs here. It's healthy to go to the internet and just look at the unemployment rate of Wichita or the unemployment rate of Fort Worth. I mean, it's informative.
Well, and here's the issue, and this I think is the reason why I was glad that you brought up the wage disinflation that you're seeing, the cost of employment coming in. People haven't given up on the immaculate disinflation story just yet. And that, I think, is really coming clear with some of the data that we're getting today, despite the strength in the labor market.
Wichita, Kansas, a tick lower than Columbus, Ohio, 3.30%. Boy, Bob Michael, yesterday, J.P. Morgan, was he on the disinflation call? If you care about the dollar, stay with us. Stephen Englander, Standard Charter. We do that next. Futures flat. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The House passed debt limit legislation forged by President Joe Biden and Speaker Kevin McCarthy that would impose restraints on government spending through the 2024 election and avert a destabilizing U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday evening.
Tonight, we all made history because this is the biggest cut and savings this Congress has ever voted for.
The measure now goes to the Senate, where approval is virtually certain. Mitch McConnell says a vote may happen as soon as today. Serbia's president called for the removal of new mayors in northern Kosovo. The flare-up started last week as the newly appointed mayors started to take up their posts in northern Kosovo. Tensions escalated on Monday when Serb protesters clashed with Kosovo police and NATO troops, leaving 30 peacekeepers and dozens of protesters injured. Elon Musk's private jet has departed Shanghai, wrapping up his first visit to China since the pandemic that included meetings with senior government officials and a late-night visit to Tesla's Shanghai Gigafactory. In a video released by Tesla's China team, Musk was shown waving to the workers, then thanking them for being at the factory late at night. He also congratulated the staff on their amazing work. And Amazon has agreed to pay just over $30 million to resolve two cases brought on by the FTC. Now, in the first case, the agency says the company didn't take enough steps to protect the privacy of users of its Ring video doorbell. The second case involves Amazon's Alexa-powered speakers, which the Justice Department says collected information about children under the age of 13 without their parents' consent. Amazon disagrees with those claims. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We think that the dollar has probably peaked because the U.S. is probably near the end of its tightening cycle, but we don't think that the Eurozone is near the end of its tightening cycle. And the Japanese markets have been performing fairly well, and they too could see tighter monetary policy as the year progresses.
Tracy McMillan, Wells Fargo, she's talking about a dwindling consumer. We certainly have seen that in Macy's today, but this is just out, and Lisa nailed this morning repeatedly. I'm looking at love. I got to get some love here. In the pandemic, I go from 60 down to near 20, and I get a 60 rebound and a big rollover in the share price. Meanwhile, the headlines come out, and there's some love with Southwest today.
So they upgraded some of their forecasts. They expect solid profits in the second quarter and for the full year. And you are seeing a little bit of a lift, up 0.2%. But to me, the big takeaway is people are still going to Southwest, and they still are using this airline despite the debacle over the winter holidays. And that, I think, that rebound is really what has been surprising. They said that demand during Memorial Day weekend was incredibly strong. They see capacity up 14 to 15%, and people will continue to fly. And this really flies in the face of exactly what you're saying. People pulling back buying, say, I don't know, new shirts and saying, okay, well, we'll fly around the country instead.
It's interesting to see, and we're going to see a lot of other reports on this, I'm sure, moving out here. What you see right now is green and red on the screen. SPX fractionally high. I'm going to call it a fractional Thursday here with the VIX 17.42. Yields are in, and this is off all that economic data, 4.39% in the 2-year yield. I don't have an inversion story, excuse me, for you this morning of really any merit. I would note the 3-month 10-year spread is challenging at 178 basis points. In oil, we're watching, Lisa, $68.42 a barrel out in West Texas. I'm not used to that.
And it's something that Riyadh is very unhappy with, which we found out in terms of their messaging for this weekend's meeting.
Javier Blas was lights out today. I mean, very delicate. I mean, am I correct? We've been banned. Bloomberg and other news organizations have been.
They extend invitations to different specific journalists, and none from Bloomberg, Reuters, or the Wall Street Journal
They didn't extend
have
an
received
invitation to Javier
invitations to one of the first in-person Vienna meetings that they've had in a while. And this comes as they are very concerned about short sellers, about whatever else is keeping prices lower than they'd like to see.
Stay tuned to Bloomberg News and Bloomberg Opinion for our coverage of hydrocarbons, that led by Will Kennedy. They're really one of our world-class outfits, if you will. We'll have all that coverage even removed from the halls of Vienna. Right now, and this is a joy for Global Wall Street, they will stop at 8:49 a.m. and listen to the number one cross-rate strategist in the world. Bill Winters leans on him. Stephen Engler joins us, global head of G10 FX Research at Standard Charter. I want you to tell me, Steve, how your Excel spreadsheet adjusts to China's slowdown and the information of cross rates
to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was That was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus.
The B-team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus, and I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful, and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then it's where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. Asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000!
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building this social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, It was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money, I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. You know, people telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this.
I made the options video where I was like, options are just like shopping.
Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price?
And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like the stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible. which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home, but in rural areas it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing,
Google in the morning,
and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants.